So good morning. So welcome to fourth day of marathon for SCM. Today we are going to cover target costing, pricing decisions, product life cycle costing, asset life cycle costing. Let us see first target costing. Okay. See, traditionally, how do we fix a selling price? Based on total cost what we incur, we are going to add some profit, then we are going to fix selling price. So this is what happens traditionally. But under target costing, due to heavy competition nowadays, price is not going to fixed by us because price is going to given by the market. So let us see the reason why it is. So let us say if you are manufacturing a product for 50 rupees, the cost of manufacturing of a product is 50 and you wanted a margin of 20%. So you wanted to sell it for 60 rupees. But the same product, most of our competitors are selling it for 45 rupees itself. Can you sell at 60 now? Definitely not. Most of the customers may not willing to buy at 60 rupees. So then what should we do? We should fix my selling price also to 45 rupees. And let us say if you want a margin of 10 rupees, it means you are supposed to produce your product within 35 rupees because market is giving the selling price. So selling price is given by the market, not fixed by you. And from that, you are going to deduct the desired profit. You are going to deduct desired profit for you. And based on that, you are going to get the cost within which you are supposed to complete your production. Clear? That is maximum allowable cost for you. It includes like production cost, marketing cost, selling cost, everything we are supposed to complete within 35 rupees. Clear? So what is the equation? Traditionally, profit is equal to sales minus cost. But we are not going to fix profit. We are going to fix required cost. We are going to fix required cost within which we are supposed to complete our production. It means our target cost is equal to market price minus the price which is given by the market minus the desired profit. Minus desired profit. This is the traditional equation. This is the equation under target costing. Clear? Sir, when should we decide how much should be our target costing? At the design stage of a product itself, we are going to decide how much is our target costing. Sir, why should I fix at the design stage itself? Because first, you are going to analyze, you are going to go with market, analyze it, and at what is the maximum price customers are willing to pay. You are going to get that price. And you are going to fix your desired profit based on your opportunity cost or based on your ROI. You are going to fix your desired profit. Clear? Then you are going to get how much within what cost you are supposed to manufacture. Now you are going to analyze what will be the cost now. What will be the cost today now if you manufacture it. So let us say my target cost is 35, but today based on current process, what I'm using for manufacturing, I came to know that it is going to be incurred 40 rupees. Then I'm going to check the difference between these two, whether I can reduce this in a foreseeable period or not. In a short period, can we reduce my cost from 40 rupees, which is my current cost, and 35 is nothing but my target cost. Can we able to reduce this one from 40 to 35 or not? That's what we are going to check it. And this is the gap. This is the gap, and we call it as target cost reduction scheme amount. Target reduction scheme amount is 5 rupees. Is that achievable? If it is yes, you can take the project and you can start producing. If you believe that no, this is definitely cannot be achievable, then stop doing this business and do some other business. Clear? That's what target costing will tells you. Okay. So let us see some problems based on target costing. Now, Silo company has a capacity of producing 80,000 units and presently sell 20,000 units at 100 each. The demand is sensitive to the selling price, and it has been observed that every reduction in 10 rupees in selling price, the demand is doubled. See here, if you observe here, you are having a capacity of 80,000 units, but you are producing only 20,000 units now. It means you can produce more than 20,000 units, but your selling capacity is only 20,000. And what they are saying is that if you reduce your price by 10 rupees every time, the production get doubles. Let us say now you are selling at 100 rupees and you are able to sell 20,000 units. If you reduce your selling price 10 rupees, your sale units gets doubles, and if again 10 rupees, again your sales get double. It means if you sell at full capacity, the price what you have to keep it is 80 rupees. Okay. Now, what should be the target cost at full capacity if the margin on sales is 25%? If you want a margin on sales of 25%, what should be the target cost at full capacity? Sir, at full capacity, what is the price what market is giving us? 80 rupees. You cannot sell more than for 80 rupees. So the market is giving 80 rupees. And what is your target cost? That should be market price minus desired profit. So which is nothing but what is the market price? 80. And how much is your desired profit? 25% of 80. So 25% of 80. Clear? So that will be equal to 20 rupees. So 80 minus 20. So 60 has to be your desired cost. What did I write? This is the desired cost or target cost. That is the first bit answer. What should be the target cost at full capacity if you want a margin of 25%? Okay. Then what? Sir, what should be the cost reduction scheme? Cost reduction scheme at full capacity if at present level 40% of the cost is variable. Sir, at present level, what is the selling price? 100. So 40% of the cost, total cost they are saying. Clear? So at present selling price is equal to 100. Profit is 25%, which is equal to 25 rupees. So 75 rupees is the cost. Now out of that 75 rupees, 40% of the cost is variable. So 75 into 40%, 30 rupees. So variable cost is equal to 75 into 40%, which will be equal to 30 rupees per unit. Clear? That's what, see, they clearly telling us what should be the cost reduction scheme at full capacity if at the present level 40% of cost is variable and total fixed cost is 36. It means at present level total fixed cost is 36 and we have to apply that at full capacity. So variable cost per unit is 30 and fixed cost is equal to 36 lakhs. Then what is total cost for us? Total cost is equal to, at full capacity we are producing 80,000 into 30 plus 36 lakhs is the total cost for us. So how much it has to be? 24 lakhs plus 36 lakhs, which is 60 lakhs is the total cost at full capacity at present. Clear? Then what is our target cost? Target cost per unit is 60 rupees. So for 80,000 units, it has to be 60. Within 60 rupees, we have to complete our target cost at full capacity. Clear? So it has to be 80,000 into 60, which is 48 lakhs. Which is 48 lakhs. Now, what is target reduction scheme amount? That has to be 60 lakhs minus 48 lakhs. That has to be cost reduction scheme amount, which is 12 lakhs. Sir, what second question what they're asking is, what should be the cost reduction scheme amount at full capacity, comma, if at present level is nothing but 20 units at which we are selling at 100 rupees, right? 40% of the cost at present, what is the cost? 100 rupees is the selling price and our margin is 25%, 75 will be the cost. So for that 75, we have to apply this 40%. So where the cost, variable cost per unit is 30 rupees and fixed cost is given as 36 lakhs. Now sir, if you are increasing the capacity also, still variable cost per unit will be the same and total fixed cost will be the same. So under marginal costing, we have seen that variable cost per unit it is constant and total fixed cost is constant. Clear? So at 80% capacity, at 80,000 capacity, our total cost, current total cost will be equal to 60 lakhs and the target cost is 48 lakhs. So that we have to reduce 12 lakhs. That is what our cost reduction scheme. Okay, next. If the required rate of return desired is 16%, let us say if you want a margin of 16%, then what will be the maximum investment at full capacity? How much should be the maximum investment you are supposed to keep at full capacity? So that's what they are saying. Sir, first, what is the profit we are getting at full capacity? At full capacity, profit is, selling price is 80 rupees and 25% is the margin. Profit is equal to 20 rupees. Clear? Then what is total profit? Total profit is equal to 80,000 into 20 rupees, which is equal to 16 lakhs. Because at full capacity they are asking. At full capacity, we are going to sell 80,000 units at 80 rupees and the margin is 25%. So that 20 rupees is the margin and total profit is 16 lakhs. Now what they are asking, sir? If our desired margin is 16%, then what should be the maximum investment? So they are asking ROI should be 16%. What is ROI? Return by investment. Return by investment is equal to 16 lakhs. Then that implies what should be the investment? Return by investment is equal to 16%. Return is 16 lakhs. Then what should be investment is equal to? Investment is equal to 16 lakhs divided by 16%, which is equal to 1 CR. 16 lakhs divided by 16%, which is equal to 1 CR. That should be our desired or target investment to get, or that is the maximum investment we should make to get a return of 16%. Clear? That's about this first question. Now let us see illustration 2. So once go through this question once, take 2 minutes time and go through the question. Okay, see here. S Limited has a sales of 2 lakh units at a price of 100 per unit and a profit of 70 lakhs in the current year. So S Limited is having a sales of 2 lakh units and they are selling each unit at 100 per unit and they're getting profit of 70 lakhs in the current year. Okay. Due to stiff competition, next year the company has to reduce its price by 3% to achieve the same target volume of the sales. It means to sell same volume of the sales. It means current year also they wanted to sell 2 lakh units, but to achieve that one, due to stiff competition, my selling price has to be reduced by 3 rupees, 3%. That's nothing but 3 rupees. 100 into 3%, 3 rupees. Now the cost structure and the profit for the current year is given below. So we are getting 70 lakhs profit, right? So 2 lakhs into 100, that will be the my total sales. Now you check it. So totally 200 lakhs will be my sales. Out of that, material cost is 50 lakhs, direct wages is 40 lakhs, variable cost is 15 lakhs, fixed overheads including selling and administrative expenses has to be 25 lakhs and total cost is 130 lakhs. So that from 200 lakhs, if we deduct 130 lakhs, we are going to get 70 lakhs as margin in current period. Now, to achieve the target cost, to maintain the same profit, sir, they wanted same profit, sir. And the volume is not changing, they wanted to sell same volume. Sir, if you wanted same profit, sir, let us say, last year we are selling for 100 rupees. And 70 rupees is the cost and we are getting 30 rupees as profit, let us assume. Now, if selling price is decreased by 3 rupees, if you wanted to get the same 30 rupees, then your cost also has to reduce by same 3 rupees, not 3%. Sir, again, listen, to maintain the same profit, how much ever the sales amount it is reducing, your cost also has to reduce by the same amount, not the same percentage. Because here it is 3%. Now, what is 3% on 70 then? 2.1 rupees only. Got it right? Your sales is reduced by 3 rupees, but your cost is reduced by 2.1 rupee only. Then definitely you are not going to maintain the same profit. But if it is reduces by the same amount, so let's say what is 3 rupees, 67 rupees. If sales is decreased by 3 rupees, your cost also has to be reduced by 3 rupees. Then you can maintain the same profit. Then for this question, they're asking that if you wanted to maintain the same profit, what should be the target cost to be achieved? They are saying. So that's nothing but how much is a reduction in sales is equal to 2 lakhs into 100 into 3%. This is the total reduction in sales. Which is 6 lakhs. Clear? So that implies what is target reduction in cost to achieve the same profit. Target reduction in cost should also be equal to 6 lakhs. Then only we are going to get the same profit. Clear? Now, to do that, to reduce that, what company is doing? Let us see now. Now, the company is evaluating the proposal to reduce labor cost and fixed factory overheads. So, they wanted to reduce labor cost as well as fixed factory overheads. Okay, a vendor supplying the machine suitable for the company's operation has offered an advanced semi-automatic machine of 10 lakhs as a replacement of old machine worth 3 lakhs. Sir, what they're doing now is, to achieve this reduction of 6 lakhs, they wanted to change the new advanced machine. It means they wanted to sell the old machine and they wanted to buy a new machine to achieve this target. So let us see one by one. And one thing, sir, due to stiff competition in the next year, they're talking about in the next year only. This is one thing very important. So in the next year only, they wanted to maintain the same profit. So I should talk about only the next year. I should not talk about total impact of every year. Just talk about the next year. Clear? Because in the next year they wanted to maintain same target volume of the sales. Clear? So just to evaluate how much cost is saving, or how much revenue we are getting additionally, or how much cost additionally we are incurring due to change of machinery, and then check it whether we can achieve it or not. Okay? Now, here the vendor is agreeable to take back the old machine at 1 lakh. See, old machine is worth of 3 lakhs. He is going to take this one and is going to give the new machine, but is valuing it as only 1 lakh. It means how much money I am supposed to pay. So he is going to take 3 lakhs worth of machine and is going to give us 10 lakhs worth of machine, but is considering this value as only 1 lakh. It means net effect we are supposed to pay 9 lakh rupee. So to change the process, we have to bring additionally 9 lakhs rupees to the business. Okay, the vendor is agreeable to take back. Okay, the company's policy is to charge depreciation at 15% on WDV. So the company is charging depreciation of 15% on WDV. The maintenance charge of existing machine is 1 lakh per annum, whereas there will be a warranty of service free cost of a new machine for the first 2 years. See, if you go with the existing machine, in the next year you are going to incur a service cost of 1 lakh. But if you go with the new machine, you are going to save it because it is service free for the first 2 years. There are 7 supervisors whose salary is 1.5 lakhs per annum. At present, there are 7 supervisors who is getting 1.5 lakhs each per annum. The new machine having conveyor belt is expected to help in cost cutting measures in the following ways. As the new machine is advanced semi-automatic one, it can save some cost by in the following ways they are saying. Improve productivity of workers by 10%. Sir, listen this point, very important one. See, how much is the wages you are paying now? 40 lakhs. 40 lakhs is the total wages you are paying now. Now, at present, your productivity is increasing by 10%. At present, your productivity is increasing by 10%. What does it mean? What do you mean by increasing the productivity? It means that in the place of 100 units, now we can manufacture 110 units. Sir, there is a slight difference between those two, sir. Productivity is increasing by 10% in the sense our cost is not saving by 10%. Within the same time, we can produce 10% extra units. Sir, this is one logic. Sir, if now it is 100, sorry, if you are achieving 10% additionally, it will become 110. So from 110, if you deduct 10%, it will be 11 rupees, sir, and you are going to get 99. You are going to get 99, not 100. It means your cost is not saving by 10%. Your productivity is increasing. Did they told you your labor cost is reduced by 10%? No. They did not tell you that your labor cost is reduced by 10%. Your productivity is increased by 10%. What do you mean by productivity is increasing by 10%? It means that in the place of 100 units, now you can manufacture 110 units. Sir, for the work what we paid 40 lakhs. For the work what we paid 40 lakhs. Earlier how much of the work we got it? We will get 10% extra work. It means that this 40 lakhs will be for 110% of the work in current period. Clear? Sir, as our productivity is increasing by 10%, within the same time, we can produce 10% extra productivity. So with that time, with the given time, we paid 40 lakhs earlier. Now also we'll pay same 40 lakhs earlier, because monthly payment or hourly payment, periodically we are going to pay 40 lakhs. But that 40 lakhs will be for 110 productivity, 110% of the productivity. Clear? Then what should be your savings in wages then? Your savings in wages has to be 40 lakhs is paid for 110%, and how much you are paying for 100%. That will be the revised wages. From those, so from 40 lakhs what you are paying earlier, if you deduct revised wages, then you are going to get how much is the wages you are paying now. Understood, right? Sorry, this is the wages what you are paying now, and from earlier wages, if you deduct the wages what you are paying now, you are going to get savings in wages. Savings in wages, like cost cutting material by 5%. So your material cost is reduced by 5%. Elimination of elimination of services of supervisors because of automatic facilities of the mission. So what they are saying is that earlier we are having 7 supervisors, but we can eliminate them because of more automatic machines, less labor. If more automatic machines, required labor will be lower, so that obviously supervisors, number of supervisors required also will be get lower. Now savings in packing cost will be 1 lakh. They're saying now assume that cost of capital to be 15%. Calculate how many supervisors should be redeemed from the production activities to achieve the target cost. Sir, this question is simple, that to achieve the target cost, how many supervisors has to be removed? That's what they are saying. So what is my target production cost? 6 lakhs. Now we are changing the machinery. Due to change in machinery, what is our savings in cost and what is the additional cost we incurred? Then we are going to get net savings. If the net saving is lower than 6 lakhs, then we are going to remove the supervisors. If that is so, how many supervisors we are supposed to remove? That's what they are asking. Let us see that. First, savings in cost due to change in machinery. So first let's find out what are the different savings in cost due to change in machinery, as well as let us also show what is additional cost due to change in machinery. That is also, let us see, in P&L account, how much your cost is increasing due to change in machinery. Let us show both savings in cost due to change in machinery as well as additional cost due to change in machinery. Let us see one by one. A vendor is supplying a machine suitable for the company's operation, offered an advanced technology semi-automatic machine of 10 lakhs and the replacement of cost is 3 lakhs. Old machine worth of 3 lakhs, but the vendor is agreeing to take only for 1 lakh. It means there is a loss from old machine of 2 lakhs, right? And that should be immediately transferred to P&L account. Whenever we are selling at lower than book value, definitely we have to transfer to, so we have to recognize the loss in P&L account. So that is loss side, additional cost. Loss on sale of machinery will be 2 lakhs. So that is immediately recognized, and question is also bothering about next year only. In the next year, your in P&L account, you are going to write loss on sale of machinery 2 lakhs. Clear? Okay. Next one. The company policy is to charge 15% of depreciation. Just get in a sequencer. You can easily write it that answer, right? So depreciation is 15%. Now what is additional depreciation now? Additional depreciation. Sir, last time we are providing depreciation on 3 lakhs. So now we are providing depreciation on 10 lakhs, sir. First year, 10 lakhs. So 10 lakhs into 15%. Sorry, depreciation as 15% minus 3 lakhs into 15%. That has to be the additional depreciation what we are incurring. Clear, sir? If I might have continued with old machine, my depreciation might be 15% on 3 lakhs. But now my depreciation is 15% on 10 lakhs. So what is additional depreciation? 3 lakhs into 15%, 45,000. And now it is 1 lakh 50. So 1 lakh 5,000 is the additional depreciation what we are incurring. Next, sir. The maintenance charge of existing machine is 1 lakh per annum, whereas there will be warranty of service free cost for the new machine for the first 2 years. As per the first 2 years, we no need to pay service charges. We are saving 1 lakh rupee, because if you might have continued with old machine, you might have incurred 1 lakh, but now you are saving that 1 lakh. So write it under saving. Savings in maintenance charges 1 lakh. Next, sir. There are 7 supervisors. Supervisors we have to adjust at the end, because by knowing how much is additional savings we do require, based on that only supervisors, number of supervisors to be removed, we can calculate it. Okay. Now the new machine has conveyor belt and saving some cost they are saving. Now savings in wages. Savings in wages. Sir, earlier we are paying 40 lakhs. But the same 40 lakhs we can pay for 110% of the work. But I want only 100% of the work, right? So it means for 110% of the work, if it is 40 lakhs, for 100% of the work, how much it is? Let us check. It is 3,63,636 minus 40 lakhs. So we are saving 40 lakhs minus 40 lakhs. So we are saving 3,63,636 rupees we are saving. That will be the savings in wages. Next. Cut down in material wastage by 5%, savings in materials. So 50 lakhs into 5%. That is 2,50,000. Next. savings in packing cost of 1 lakh. Savings in packing cost is 1 lakh. Then assume cost of capital is 15%. Sir, to change the machinery, we should spend 9 lakhs. We should spend 9 lakh rupee additionally. Sir, in study material they have given us 10 lakhs, but ignore that because they are saying that new mission cost is 10 lakhs and is agreeing to take back old mission as an exchange, so that we are supposed to pay 9 lakhs only. Then why should I pay interest for 10 lakhs? The additional capital which I have to bring to this change of old mission to new mission is only 9 lakhs, not 10 lakhs. So our cost of capital also should be applicable on 9 lakhs, not on 10 lakhs. So 9 lakhs into 15%. Cost of capital is 15%. So it is 1,35,000. So that has to be the total additional cost on total additional savings. ₹8,13,000. 8,13,000. 8,13,636 will be my savings in cost due to change in machinery, but I am incurring additional cost also, 4,40,000. Now what is my net saving? Net savings due to change in machinery. Should be 8,13,636 minus 4,40,000, which is equal to 3,73,636 rupees. This is my net saving. Now, sir, what should be savings required from removal of supervisor is equal to total required savings is 6 lakhs. Out of that already we saved 3,73,636. What additional savings we are supposed to make? $2,26,364 is the additional savings we are supposed to make from removal of supervisors. Now therefore number of supervisors to be removed should be equal to 2,26,364, and for each supervisor we are paying 1,50,000 rupees. So 1,50,000, that is equal to 1.51 supervisors, which is nothing but to achieve the target cost, we have to remove minimum of 2 supervisors. As we cannot remove 1.51 supervisors, your answer has to be 2 supervisors. That has to be the number of supervisors to be removed. Clear? Sir, it is easy question only. The thing is that as they're asking about the only next year, we have to recognize the total loss of 2 lakhs in the next year only, because this loss in sale of machinery 2 lakhs we have to recognize in the year in which we got a loss. So in the first year itself, as we have supposed to recognize, so we have to do like this only. Clear? And this is one adjustment where we normally get doubts. The other one is wages. Sir, if productivity is increasing by 10%, it does not mean that wages is reducing by 10%. Clear? If wages is reduced by 10%, your answer might be 4 lakhs. Your answer has to be 4 lakhs because 40 into 10%. Sir, your productivity is increasing by 10%, not cost saving in wages is 10%. There is a big difference between those two. Cost savings in 10% in the sense your wages regularly whatever the wages you are paying 10% lower wages than, let us say per hour you are paying 100 rupees earlier. If there is savings in 10%, then you are going to pay 90 rupees only. But if productivity is increasing by 10%, what does it mean? You are paying earlier 100 rupees, right? In the same time, you are producing 110 units now. You are producing 110 units. Understood, right? It means for 110 units you are paying 100 rupees. Then for 100 rupees, how much you are supposed to pay? This is how we are supposed to calculate. Sir, earlier you paid 100 rupees, right? In the place of that, you are producing 110% of the work due to savings in time. Now it has to be 90.91. That is the difference between these two. Reduction in the cost, it means 90, but reduction in increasing productivity by 10% in the sense your wages, your revised wages will be 90.91. Understood this logic, right? So this is the reason why we should not deduct 10% from wages. Instead, increase your productivity by 10%. So same 40 lakhs we are paying for 110%. Then how much has to be for 100%? Cross multiply that. Then you are going to get the wages to be paid. Now let us solve one more question, sir, in target costing. Read this question. Take 2 minutes time and read it. Okay. See this, sir, is one of the important question. And let us see the logics behind this question very properly. Sir, you, the manager of paper mill, have recently came across a particular type of paper which is being sold substantially lower rate than the price being charged by your own mill. Sir, our mill is XYZ Limited has recently came across that a particular type of paper ABC Limited, one of our competitor, is selling at lower, substantially lower than our mill. Then definitely we have to revise our selling price. We have to sell at least, we have to sell at the maximum price of what ABC Limited is charging. Otherwise, definitely customers are not going to buy from us. Now the value chain for, the value chain for one of the MT of such paper for ABC Limited is as follows. So value ABC Limited value chain is like that. Now they will sell to the merchant, merchant to the printer, printer to the customer. Got it? And ABC sells this particular paper to the merchant. So ABC is going to sell to the merchant at a rate of 30,400 per MT. Understood, right? It means what is the maximum selling price we can also sell at the same 30,400. We cannot sell for more than 30,400. Now ABC Limited pays for the freight which amounts to 600 per MT. Now this ABC Limited, for distributing those goods to the merchant, they are incurring 600 rupees per MT, and average sales returns and allowances amounts to 4% of the sales and approximately equal to 1200 per MT. Okay, now the value chain of our company through which the paper reaches to the ultimate customer is similar to that of ABC Limited. Sir, the value chain of ABC Limited as well as us will be the same. And remember, when value chain of two companies are same, it is assumed that all the cost to deliver and sales returns are same for both the companies. This should be the assumption. As value chain is same, whatever thing happening to our competitor will also happen for us also. See, now is selling for 30,400. It means we can also sell for 30,400 only. But to deliver that, our competitor is incurring 600 per MT. Even we are going to incur 600 per MT. And the average sales returns and allowances amounts to 4% of the sales, which is 1200 per MT. And we are also going to get the same sales returns. Then only we say that the value chain of both the companies are equal. Then what will be our net selling price? So calculation of net selling price for us, whatever the net selling price is there for our competitor, the same will be there for us also. Now what is sales per MT by ABC? The same thing will be there for us also, that is which is 30,400. So minus, they are incurring freight amounts to 600 per MT, minus freight charges, we are also going to incur the same, and minus sales returns will be 1200. Now this has to be net selling price per MT, which is 28,600. Now sir, what they are asking, however, your mill does not sell directly to the merchant, the latter receives the paper from the huge distribution center maintained by your company at Haryana. So what they are doing is that ABC company directly they are sending to merchant, but XYZ Limited, what they are doing, as they are very far away, might be from the merchant. So they are having one distribution center, and from distributions ABC to distribution centers goods will move, and from distribution center to merchant only goods is going to get moved. Sir, as value chain is same, how much ever ABC Limited incurred cost to deliver the merchant, the same will happen to the distribution center. It means what is the net selling price for ABC to the merchant? 28,600. For distribution center also it has to be 28,600. But as our company is having one more extra chain, we see, sir, this total belongs to our company only. This total belongs to our company only. From our company to the merchant, we will get the same amount as what ABC is getting. So distribution center is only going to get 28,600. But to transfer from ABC to distribution center, we may incur some cost. Let us see the details of remaining. So the shipment cost from the mill to the distribution center amounts to 200 per MT. So from shifting from ABC to XYZ to distribution center, for shipment cost will be 200 rupees. Well, the operating cost in distribution center is estimated to be 125, and this distribution center is going to incur 125 rupees as operating cost. The rate of return on investment required by the distribution center is also 120, and distribution center requires 120 rupees profit. Now you are required to compute mill manufacturing cost. What is the manufacturing cost we are incurring for the mill? For a particular paper for our company, you may assume that the return on the investment is expected by our company is 120 per MT on such paper. Sir, XYZ wants 120 as margin. Distribution center also wants 120. It means that what is our target cost, sir? So this is the net selling price. From this selling price, if we deduct desired profit, then how much is desired profit? 120 rupees. If we deduct that 120, then 28,480 has to be target cost, target total cost. Sir, from the target total cost, if we remove all the cost which we incurred for distribution center, then we are going to get mill manufacturing cost. They are asking us how much is the manufacturing cost of the target, mill manufacturing target cost. Simple, sir. Out of total target cost, if we remove other than the manufacturing cost, then we are going to get the target manufacturing cost. What is other than manufacturing cost? Distribution center shipment is 200 rupees, and operating cost in distribution center is 125 rupees, and the profit margin what they require on the investment what they did for operations is 120. If we deduct all those three things, then we are going to get the target mill manufacturing cost. So deduct those three. So from that, deduct shipping cost, shipping to distribution center is 200, minus operating cost in distribution center ₹125, minus profit required by distribution center, 120 rupees. Now we are going to get target manufacturing cost. $28,035 has to be the target mill manufacturing cost. Sir, when such questions are given in exam, first remember, if they are asking you that value chain of ABC Limited and value chain of our competitor, one of the competitors' business is also same, then whatever the cost, whatever the selling price they can incur, we can also incur the same selling price. We can also sell the at same selling price. We cannot sell more than that one because merchants is not going to agree if we sell for more than what competitor is giving. If you try to fix more than that, they are going to go with our competitors. They are not going to go with us. Clear? So the maximum selling price what I can sell it is 30,400. Clear? From that, as value chain is same, whatever the cost they incurred to deliver the material as well as sales returns, the same thing will be repeated for us also. So if after deducting those two things, then we are going to get net selling price per MT. Per MT, how much we are going to get? That is the maximum amount what we are going to get it. From that, that is the net selling price. From that, if we deduct desired profit, then we are going to get target cost. So how much is the profit we do require? 120 rupees. So deduct that 120, then we are going to get the target cost within which our total cost has to be completed. Now in question they didn't ask us to find out target cost. Instead they asked target manufacturing cost. So from target total cost, if we deduct other than manufacturing cost, then we are going to get target manufacturing cost. Other than manufacturing cost is nothing but the cost which we incurred in distribution center. So what are the different costs we incurred in distribution center? So to transport goods from manufacturing to distribution center, we are incurring 200 rupees that, as well as operating cost in distribution center is 125 rupees, as well as to start distribution center, we bought some capital from outside. From that, for that we are supposed to pay some cost of capital. So that cost of capital is 120 rupees. Even that is also a cost only, sir. That will be an opportunity cost that is to be considered. In relevant costing, we have seen very clearly in costing, opportunity costs are taken, opportunity costs are considered. Clear? So 120. If we deduct all those things, then we are going to get target mill manufacturing cost. So within which we are supposed to complete our manufacturing. So which is 28,035. So this is how the target costing questions will be. It will be very simple. Question will guide you very properly. Try to understand the question. Just follow line by line. You can easily complete target costing questions. So let us see next topic, product life cycle costing. Product life cycle costing. Sir, if you can remember your cost sheet, whenever we are preparing a cost sheet, we normally start with direct material consumed. Sir, but what about before even bringing the raw material? Are we going to incur any cost? Before even incurring material cost, before even starting up a product, are we going to incur any cost? Yes, sir, we are going to incur. What are those? Design cost, planning cost, setup cost. Understood, right? Every such cost we are going to incur. Marketing cost, R&D, I mean to say, R&D cost, research and development cost. All such costs are not taken in cost sheet, and traditionally we started consuming or assuming cost into the cost sheet when our production starts. But there are some costs which will be incurred even before producing the production. Now these product life cycle costing will consider every cost, sir, from the design stage to. So let us say if you wanted to start up one project, new products, straight away new product you are manufacturing. So before manufacturing only, you are going to incur planning cost, design cost, or R&D cost and all, right? From that stage to, from starting from development stage to end of the product, development stage to end of the product, what and all cost we incurred, every such cost, if you take it in one statement, that is called as product life cycle costing. So they are giving one 7 marks question from product life cycle costing or asset life cycle costing at least once in 2 attempts. That very easy marks, sir, those are, because we have to just add the total cost from the very beginning to the end. Just add them and you say that this is the total product life cycle cost. Clear? So traditionally we consider only when production, we normally take income statement or we normally prepare a cost sheet and we try to find out the profit. We try to find out the profit from production, from the start of the production. But product life cycle costing will take very way beginning from developing, research and development or design stage, planning stage itself we are going to start, and from that to the end, let's say life is 4 years, they will take 4 years sales, all the 4 years sales, all the research and development cost, all the product design cost and manufacturing cost for all the 4 years. Likewise, from starting, from product starting to product end, if we take all the cost in one statement, that is called as product life cycle costing. So let us see one problem so that you can understand. See this illustration one. Read it once, go through the question once. Okay, so let us see. Zenith Limited manufactures a tablet batteries. The company is preparing a product life cycle budget for the new type of battery. Development on new battery is to start shortly. Estimates for the new battery are as follows. Sir, life cycle units manufactured and sold. Totally, we are going to manufacture and sell 2 lakh units. Now, selling price per battery is 55. Then what should be the total sales in whole life, sir? Because under life cycle costing, we are not going to calculate any periodical things. Not per annum, not per month, not per quarter, not per half yearly, nothing. For the whole life, we are going to make one statement. From sales, we are going to deduct all the revenue and we are going to check from the whole life of a product how much can be the profit we can make. See, clear? So that we have to take for the whole life. But in product life cycle costing, time value of money is ignored, sir. Product life cycle costing, time value of money is ignored for the whole life. How much is the total revenue or total money we can generate it? That's what we are supposed to calculate it. So it is So it is 1 crore 10 lakhs. That has to be the total sales. Now R&D, sir, I have to take all the R&D. 8 lakhs total I am supposed to take it. Next, manufacturing. Variable cost per battery is 25 rupees. So it has to be 50 lakhs. So we have to consider whole 50 lakhs. Then variable cost per batch is given, sir. Understand very properly. And batteries per batch is 250. Then for 200 lakhs units, how many batches we are going to get? Each batch contains 250 batteries, and totally we are going to manufacture 200 lakhs. Clear? Yeah, totally we are going to manufacture total units manufactured will be 2 lakhs, and per batch it has to be 250. So 2 lakh by 250 into 300. That has to be the variable cost per batch. So it has to be 2 lakhs. So it has to be 2,40,000. That is also a cost. Next, fixed cost, the total 12 lakhs I am supposed to take it. Then marketing. Variable cost per battery. Per battery they are given. So it is 2 lakhs into 3.5. Which is 7 lakhs. Then fixed cost 8 lakhs. Totally we are supposed to take 8 lakhs. Then distribution, sir. Variable cost per batch. Sir, manufacturing units per batch, distribution units per batch may not be the same. When you are producing, you can produce in the batches of 250, but even when you are distributing, you can distribute in the batches of 100. So it has to be 2 lakhs total units, and each batch is 100. Then we are going to get number of batches into 140 rupees. That will be the total cost per life of a product. So that is 2 lakhs divided by 100 into 140. It is 2,80,000. Now fixed cost is 4,60,000. Total 4,60,000 is taken. Then customer service cost per battery is variable. That is 2 lakh into 1.7, which is 3,40,000. So this will be the total cost. Then we are going to get, and they are also telling that ignore time value of money. Clear? So from 110 lakhs we should deduct 8 lakhs, 50 lakhs, 2.4 lakhs, 12 lakhs, 7 lakhs, 8 lakhs, 2.8 lakhs, 4.6 lakhs, and 3.4 lakhs. So totally we are getting 11,80,000 as margin. So 11,80,000 has to be your margin. Now what is the second part of the C? So calculate budgeted life cycle operating income for a battery, for the battery. Sir, only operating income they are saying. Sir, what do you mean by operating income? Most of the people may say that as they are asking only operating income, let me calculate only up to this. Only up to this. Sir, but operations is not just production, manufacturing. Operation in the sense all the things whatever you see in costing is operations only. Operations has 3 departments, sir. Purchase department, production department, selling department, and it also includes administration of admin office also, sir. Operation in the sense the activities what we are supposed to do in a day-to-day basis. Purchase happenings on a day-to-day basis, production happen on the day-to-day basis, administrative activities also happens on a day-to-day basis, selling also happening on a day-to-day basis, marketing things also happens on a day-to-day basis. Everything comes under sales, marketing, advertisement, selling expenses, all that also will going to happen on a day-to-day basis. So all these things will going to be on a day-to-day basis, combinedly called as operations. So it means that operating income is this only, 11,80,000 only. This is what EBIT. operating income. From this we are going to deduct interest, tax, which we are supposed to pay to government, and preference dividend, and rest of the amount we are going to give for equity shareholders. So this is operating income, sir. Don't just take up to manufacturing. Most of the people are believing that operations are equal to manufacturing costs. No, sir. Operations means every day-to-day activities comes under operations only. Clear? Okay. Next, what percentage of budget total product life cycle cost will be incurred by the end of R&D and design stage? Sir, by the end of R&D and design stage, what percentage of the total cost will be incurred? So, what is R&D and design cost? 8 lakhs. What is our total cost? 8 lakhs divided by my total cost is so we got a margin of 11 lakh 80 from 110 minus 11.8. Sir, 98 lakh 20,000 will be our total cost. Out of the total cost, how much is R&D cost percentage? That's what they are asking. See, what percentage budget total product lifecycle cost will be incurred by the end of R&D? It's nothing but out of total cost, how much is the R&D and design cost? That's what they are saying. That has to be 8 lakhs divided by 98 lakhs into 100. Next, third bit. So the company's market research department estimates that reducing selling price by 2.5. It means if we are reducing selling price by 2.5, it is if you fix 52.5 as selling price, it will increase life cycle units by 8%. So that your units are going to be increasing by 8%. So totally you can produce and sell 2,16,000 units if you can reduce the selling price, they are saying. If unit sales increases by 8%, the company plans to increase manufacturing and distribution batch size by 8% as well as. So batch sizes also will be increasing by 8%. That's what they are saying. It means that in the place of 250, you are going to manufacture 270, because see here, if unit sales increases by 8%, the company plans to increase manufacturing and distribution batch sizes by 8% as well as. And in the place of 100, we are going to take 108. That also increases by 8%, they are saying. Assume that all variable costs for battery per batch and fixed cost will remain the same. Should the company reduce the price by 2.5? Should they reduce by 2.5? That's what they are saying. So for these values, for the whatever the changes we are doing, with those changes, do the revised calculations for the profit. And if the revised profit is greater than 11,80,000, then you can ignore. Sorry, greater than 11,80,000, then you can change it. If it is less than that, you can ignore and continue with the same 55 rupees. Clear? So, understood, right? I am not doing that, but you understood, right? So, sales I am supposed to take 2,16,000 into 52.5. R&D cost is fixed one, same you take it. And here 2,16,000 into 25 rupees. And here 2,16,000 divided by 270 into 300. Amount is not changing, but batch size is changing. So here it will be 12 lakhs same, and its variable cost per battery, it is 2,16,000 into 3.5. Here 8 lakhs will be the same, and here it has to be 2,16,000 divided by 108 into 140. We are going to get fixed cost will be the same, and here we are going to get 2,16,000 into 1.7. So from the total sales of 2,16,000 into 52.5, all the cost, deduct it and calculate the margin. If margin is greater, advise them to change it. If the margin is lower than earlier, then don't advise them to change it and ask them to continue with 55 rupees only. Yeah. That's how the product life cycle costing questions will be from the starting, from very beginning, from research and development and designs to every cost which is incurred till the end of the life of the product. You are going to add it and you are going to deduct it that from the total sales what you can generate in all the life of the product, life of the project, and then you are going to decide how much, so then you are going to get how much will be the, how much the profit you can generate. Clear? Okay, that's about product life cycle costing. So next, let us start with asset life cycle costing. So it takes some time to explain you asset life cycle costing. So meantime, you can take 5 minutes break so that we can continue with next topic. So you can take break up to 10:10. Okay, so next let's start with asset life cycle costing. Sir, under asset life cycle costing, similar to product life cycle costing, we are going to consider all the cost what we incur for the asset. Understood? What is all the cost means? So let us say, sir, there are two missions A and B. I have to choose one mission. To choose one mission, I am doing some background work where I am incurring 10,000 rupees cost. Even that also considered. So we're planning, right, based on our plans, which missionary is to be selected, or we are taking opinion from some of the experts by paying some amount. Even that we are going to take it. Or else, sir, let us say if we are building our own missionary. Sometimes in manufacturing units, big manufacturing units, they are going to build their own missionary. So they may call one of the mechanical engineer and all. They are going to ask to get a design charges, plan and design. So plan and design charges we are going to incur, plus acquiring, from bringing the raw material to build a material, or construction of the material, construction of the machinery, whatever the cost we incur, all such construction of the cost. Now, from that to the end of the mission life, all the running cost, maintenance cost, repairs cost, everything, overhauling cost, every other things if we consider, and if we make it in one statement, from planning and design cost to end of the life, by selling, whenever we are selling or to dispose, to uninstall, whatever the expense we incur, even that we include it, and if we write in one statement, that is called as asset life cycle costing. Clear, sir? Why do we do asset life cycle costing? Sir, it will help us what is the right mission has to be selected, and also it helps us what should be the optimal life cycle of a business. What is the optimal replacement cycle? So that's nothing but, let us say, sir, if the life of the machinery is 5 years, but when with life passes, like for 1 year, second year, third year, with the age of the machine increases, efficiency of the machinery decreases. It means the productivity what we can get in the first year and the productivity what we may get in the fourth year may not be the same. Sometimes it is better to, though the machinery can be useful for 5 years, sometimes it is better to sell after 3 years and buy a new machinery. So let us say a car. If you are buying a car, let us say the useful life of a car is 20 years. But how many people are using cars for 20 years, though the expected life, a car can be with proper maintenance and with proper repairs, we can maintain a car for 20 years. But we are not maintaining it, because after some years, like 8 years, 9 years, 10 years or 12 years, depends upon the car, the repairs and maintenance cost will be more than the EMI of the new car. The money what we have to spend to do repairs and maintenance of that particular car, the cost of that can be more than new car's EMI. Then it is better to buy a new car, right? So though the life is 20 years, but we have to replace the car once in 8 years or once in 10 years, so that we can save the net cost of the machinery or of the car. Similarly, machinery also, with the increase in age, as the efficiency decreases, though the economic life is 5 years, we may have to change the machinery once in every 2 years or once in every 3 years. Then what is the optimal life cycle, sir? Should we change after every 2 years, or should we change after every 4 years, or should we use till the end of the life? How do we decide, sir? What should be the optimal life cycle? That also will be given by asset life cycle costing. Clear? Now, first thing, let us discuss, if we are having two missionaries, out of those two missions, which is to be selected. Let us decide that first. So let us say, sir, there are two missions A and B. There are two missions A and B. Let us say, whatever the mission I purchase, I am going to manufacture same number of units. Based on the mission, I am not going to produce number of units. Let us say, sir, mission A cost is 10 lakhs. Mission B cost is 15 lakhs. Okay, and with A we can produce 1 lakh units per annum. With B, I can produce 8 lakh units per annum. Because more of automation, we can produce very quickly. With just increase in 50% cost, we can produce 8 times more. Then is that better to go with A or B? Immediately, we are not supposed to go with B. We are supposed to further analysis. What is my sales demand? Sir, if my sales demand is only 80,000 units, then sir, yes, I can produce 8 lakh units. This is my practical capacity. I can produce practically, I can produce 8 lakh units. But my normal capacity is always depends upon the sale units. Got it right? I am supposed to produce 80,000 units only because my sales demand is only up to 80,000 units. I cannot produce more than this. If I produce more than that, that will be idle. Clear? Then based on this only I am supposed to select which machinery is to be selected. Clear? So irrespective of the machinery I am going to purchase, the number of units which I am going to produce will be the same. It should be based on my sales demand. So that sales is not the criteria to decide. Revenue is not the criteria to decide which machinery is to be purchased. Then what, sir? Then try to take a machinery whichever is having the lowest cost. Whichever is having the lowest cost. Then how do we calculate the cost of machinery? So now let us calculate calculation of present value of cost of machinery. Now calculate present value of cost of machinery and choose the machinery whichever is having lower. Clear? Now first, present value of purchase cost. You take it present value of purchase cost. Okay. Then plus present value of operating costs, or we can also say running cost. Present value of operating cost and running cost. But sir, it has to be net of taxes. It's very important. It has to be net of taxes. Sir, why sir I am supposed to take net of taxes? Let us say A's repair and maintenance cost or running cost or operating cost, whatever we call it as, is 20,000 per annum. B's cost is 12,000 per annum. Yes, A is spending 8,000 rupees more. A is spending 8,000 rupees more, but by taking this 20,000 to the P&L account, your profit is reduced by 20,000 rupees, where you are going to pay less taxes. But if you take these 12,000, you are going to save taxes for only 12,000 rupees. But if you take 20,000 to the P&L account, you can save 20,000 rupees to the, sorry, you can save tax on 20,000 rupees. Clear? So how much is the tax saving? That is a 40% is the tax. By sending this 20,000 to the P&L account, you can save 8,000 rupees tax. By sending this 12,000 rupees, then you can save, so if it is 40%, 4,800 rupees you are going to save it. Clear? It means your net cost is, this is the saving actually, and your net cost is 16,000 rupees, sorry, 12,000 rupees. Though you spend 20,000 rupees, because of these 20,000 rupees, you are paying 8,000 rupees lower tax. It means what is the net cost of repairs and maintenance or running cost is 12,000 only. And here the net cost is 7,200 only. Clear? Now earlier the difference was 8,000 rupees, but now the difference is only 4,800 rupees. Difference is only 4,800 rupees. Clear? So if we take these 20,000 and 8,000, let us say A's cost is 2,000 rupees more, and you might have chosen B. But yes, you are saving 2,000, but in taxes it is saving the extra almost 3,200 rupees. 3,200 rupees extra it is saving. You are ignoring that, then you may take wrong decision. So it has to be net of taxes, sir. It has to be net of taxes. Otherwise, you may take wrong decision. So it has to be present value of operating cost net of taxes. If taxes are not given in question, then it's okay. Just to take present value of running cost. Then plus present value of overhauling cost. Sir, what is this overhauling cost? Is nothing but, sir, once in a while, let us say once in 5 years or once in 3 years or once in 5 years, some of the machineries has to be do some deep repairs and maintenance. Deep repairs and maintenance, they will take all the parts out, they clean it and they will install it once again. That is called as overhauling. So for that, once in 5 years or once in 6 years they are going to incur. So whenever they incur, they are going to give in a question. So after 5 years or after 6 years, just take to the present value and take it to the cost of an asset. So these are the net cost. Now normally what will be there? Purchase cost, operating cost, as well as overhauling cost. And if there is any uninstallation cost and all, if there is any sale salvage value, you can take net of that one. And if you are getting positive benefit, if you are getting a more salvage value, that is the one which you can deduct it from the total cost, so that you are going to get net cost. So from this you are going to deduct present value of salvage value. As this is the benefit, you are going to deduct it from, so that you are going to get the net cost. Sir, from machinery, not only salvage value, see here, whatever the purchase cost it is, if the purchase cost is same, then it is fine. But if purchase cost is different, the amount of depreciation also will be different. If purchase cost is different, the amount of depreciation is also different. Now such depreciations will go to P&L account once again. And based on the depreciation amount, you are going to get the tax savings on profit. So that is also because of this machinery only. So that should be also taken. So minus present value of tax savings on depreciation. Because of depreciation only, your profit decreases and you are going to pay lower taxes. That also to be considered. And this has to be, after taking all these things, you are going to get net cost of purchase. Net present value of cost of machinery. Net present value of cost of machinery. Clear? Sir, let us say net cost of machinery, this is 80,000, but this is 60,000. Which one is better, sir? Obviously B is better. But what if the life of mission A is 5 years and the life of mission B is only 3 years? Then, sir, if the life of machinery is different, then definitely my decision should not be based on present value of the total cost. So let us discuss that also. Sir, let us say there are two missions, sir. There are two missions, A, B. Cost of A is 30,000 rupees. Present value of the total cost, I'm talking about this one. Total present value of the total cost is 30,000 and B is 56,000 and life of A is 3 years, life of B is 6 years. So which one we are supposed to use it? Which one we are supposed to use it? So simply, sir, in 6 years, A has to be repeated one more time. In 6 years, A has to repeat one more time because, sir, when I'm comparing with A and B, I should not compare with A one cycle and B one cycle because life is different, right? So let us say my business is a going concern. If I choose A, every 3 years, I'm going to replace the mission. If I choose B, every 6 years, I'm going to replace the mission. Understood, right? If I'm choosing A, in 6 years, I have to repeat 2 times, right? So definitely, I should not take A saying that it is having lower cost when we compare with B, sir. Because in the time of B's one cycle, A has to be replaced twice. It means that again we are going to incur 30,000 rupees here. So then A's total cost has to be 60,000. Yes, agree? Now, sir, again, do not go with B immediately saying that A's cost is 60,000, B's cost is 56,000, because this is the cost at 0, but A's cost is at 0 we are having 30,000, at the end of third year we are having 30,000. Sir, can we compare values at different timeline and decide which one is better? Never. As per time value of money concept, we should always compare values only when they are at one timeline. It means that we have to convert this 30,000 to the A. Then only we have to make a decision which machinery has to be selected. So let us say, sir, discount rate is 10%. Then what is present value of A then? Is equal to 30,000 plus 30,000 divided by 1.1 whole cube. So it is 52,539. So which is better, sir? A is better, because B's total cost is 56,000. Present value of total cost is 56,000. A in 2 cycles combined cost is 52,539. So A is better. So what if the discount rate is only 5%? If discount rate is 5%, then it is 30,000. If this will be at 10%, if it is at 5%, then it has to be 30,000 divided by 30,000 into 1.05 whole cube. Plus 30,000, it is 55,000. Let's take 4%. Let's take discount rate as 4%. 30,000 divided by 1.04 plus 30,000. It is 56,669, sir. Got it right? So which is better now? B is better when we compare with A. It means that which machinery is better is also depends upon the cost of capital or the discounting rate what we are using. That also decides which machinery is the better one. So what we should do, sir, for one cycle, if the 3 years is the period, the other machinery if it is 6 years, then we have to repeat for 1 more year and we have to make equal life, then only we can evaluate which machinery is better. But sir, if the life is 9 years and 11 years, then what should we do? We have to repeat this for 11 years and we have to repeat this for 9 years, then only we can make life equal. So which will be very difficult task. So we cannot use this method. We cannot use this method. Then what method we can use it, sir? See here. Six years life is there, right? In the first cycle we are getting 30,000. In the second cycle also we are going to get 30,000. That is the basic assumption we are supposed to take it. And here we are getting 56,000. So now distribute these 30,000 for 3 years. And also distribute these 30,000 for 3 years. Equally. Distribute equally. And distribute these 56,000 equally for 6 years. Then you are going to get per annum, right? Then you take a machinery whichever is having lowest per annum cost. So if per annum if it is lower, then total also it has to be lower, right? So that instead of taking the total things, take it per annum cost and consider per annum things. Whichever is machinery is having per annum lower, that has to be the lowest cost. Clear? Now how to distribute, sir? How to distribute this 30,000 equally for 3 years? Here we are having 30,000. We have to distribute equally for 3 years. So do not divide it by 3 and say 10,000, because whenever you are sending 10,000 from 0 to 1, whenever you are sending value from one period to the other period, the value changes. So definitely 10,000 is not the value. If 10,000 is the value, then here itself we can say that, right, per annum it is 10,000 and per annum it is for 6 years, right? So it is less than 10,000, so that we can go for B. No, sir, no, because time value of money is to be considered. Whenever you are transferring value from 0 to future periods, definitely the value changes. Then what should be the equal amount, sir? Sir, I don't know what is equal amount. Let us say that equal amount be x value. That equal amount is x. Sir, one thing I know that if I take to the present value once again, if I take all these x values to the present value, again it has to become 30,000. So what is the present value of all those x? That is nothing but x into present value annuity factor at the rate of r percentage comma 3 years is equal to 30,000. That implies x is nothing but equivalent annual cost. Per annum cost is equal to 30,000 divided by present value annuity factor. That is nothing but total present value of cost divided by present value of annuity factor. Then you are going to get equivalent annual cost. Equivalent annual cost. So based on this, sir, for one cycle, if you distribute these 30,000 for 1, 2, 3, if the amount is some x, if you distribute these 30,000 also, the amount has to be the x only, because the amount is same on the period to which it has to be distributed is also same. So it means that for one cycle, if you calculate equivalent annual cost, that's fine. So that you no need to repeat projects for 11 times or 9 times. So it will be easy for us to make a decision that in such cases, so that whenever life is not equal, so your decisions can be taken based on net present value of total cost. When use this when life of both missions are equal. When life of both missions are equal. But if life is not equal, then make it divided by present value annuity factor at the rate of r percentage comma n years. If we divide it by, then we are going to get equivalent annual cost. Equivalent annual cost. We are going to get equivalent annual cost. Clear? And use this, and whichever is lower you can select it. Use this. When life of missions are not equal. When life of missions are not equal, then you have to go for equivalent annual cost. Understood, sir? You have to make such a statement. First, present value of purchase cost, so that you have to add present value of operating cost or running cost net of taxes. Then you have to take present value of overall cost. That's nothing but you have to take present value of all the cost what you incur. And from missions we are going to have benefits. Two benefits we are going to have it. One is salvage value. The other one is tax savings on depreciation. If we adjust those things, then we are going to get net present value of cost of machinery. To that, you can use that. If life of both missions are equal, use that net present value of total cost and select whichever is lower one. But if life is different, we cannot make a decision based on net present value of total cost. We cannot take the lower cost one, because if the higher cost one life is more than lower cost one, then the lower cost mission has to repeat more number of times compared with the higher cost machinery. Yes or no? Let us say if higher cost machinery has to be used once, lower cost machinery might be used more than once. It means that cost cannot be compared with each other. So that we are supposed to find out what is the cost per annum then. What is the cost per annum then? So distributing cost equally for the life, to distribute equally for the life, you have to divide it by present value annuity factor. Then we are going to get equivalent annual cost, and based on that you choose a machinery whichever is having lowest equivalent annual cost. Clear? Okay, let's move to problems now. See illustration 1 once. Read the question once. Okay, now let us see here. A to Z supports the concept of trio technology or life cycle costing for new investment decisions covering its engineering activities. The financial side of this philosophy is now well established and the principles ex extended to all other areas of decision making. The company is to replace number of its mission and production manager is to tone between X mission, more expensive mission with a life of 12 years and Y mission with an estimated life of 6 years. If Y mission is chosen, it is likely that it would be repeated at the end of every 6 years by another Y mission. This pattern of the missions and running cost differs between two types of missions and the relevant data is given below. So they given very clearly that if life of X is 12 years, life of Y is 6 years. If they go with 6 years machinery, in 12 years they have to repeat it 2 times. Understood, right? So that one time cost of 6 years machinery cannot be compared with one time cost of 12 years machinery. 2 times cost of 6 years machineries can be compared with 12 years, or else you can calculate equivalent annual cost, per annum cost, and you can compare. Any one of those methods can be used. Now the pattern of maintenance and running cost differs between 2 types of machines and relevant data is given below. Purchase price is given and scrap value is given and repair cost per annum is also given and overhauling cost is also given. Estimated financial cost is 10% per annum for both X and Y. We are required to recommend with supporting figures which mission to purchase, stating any assumptions made. So which of the mission is to be purchased? Sir, just you follow this one. So present value of purchase cost, present value of operating cost. As tax is not given, never bother about net of taxes. Then present value of overall cost and minus present value of salvage value. As there is no taxation, never bother about these things. No tax itself, then no tax savings in depreciation. And finally we have to divide it by present value annuity factor. See sir. Now what is purchase cost? 19,000 and 13,200. Next, let's scrap is the benefit, so it has to deduct it. So these 3 lakhs has to be 3,000 we are going to get at the end of X mission, a more expensive, life is 12 years. So what is the present value of these 3,000? 3,000 into present value factor at a rate of 10% comma 12 years. But what is the present value of these 3,000 into present value factor at a rate of 10% comma 6 years? Got it right? So take it for present value for 12 years and this is the present value for 6 years. Clear? Okay, next, annual repair cost. Okay, so this has to be the net purchase cost to that present value of total annual repair cost, that is 2,000 into, as it is annual cost, every year we are going to incur, we are supposed to use present value annuity factor at a rate of 10% comma 2 years. So 12 years, and this has to be 2,600 into present value annuity factor at a rate of 10% comma 12 years, so 6 years. That's what we are supposed to take it. Got it? So that is what present value of repair cost. Then what is present value of overall cost? So overhauling is done for at the end of 8th year for X, and this is done at the end of 4th year for Y. So this is 4,000 into present value factor at a rate of 10% comma 8 years, and for this one it is 2,000 into present value factor at a rate of 10% comma 4 years. So overhauling cost, so we are going to take it. So this is repair cost and this has to be the overall cost. Then from the net to the net cost, add these costs also, then we are going to get present value of total cost, present value of total cost, and then that should be deducted by present value annuity factor. With present value annuity factor we are supposed to deduct, so that we are going to get equivalent annual cost. And now equivalent annual cost is lower with mission X, so that we are supposed to go with mission X. As equivalent annual cost is less per X mission, it is better to purchase the same. Clear? Okay. With the simple same follow this table, follow this statement and do it. If life is same, end up to here. If life is not same, take up to equivalent annual cost and take whichever is lower. Now see second question. Read it once. Okay, done. Now let us see here. So Sunrise Precaution Limited is in the business of publishing a leading newspaper which has a wide customer base. It measures quality of service in terms of print quality, on-time delivery, number of damaged and unsold paper. So normally it is a leading newspaper business company. Now they wanted to check their quality based on three terms: print quality, on-time delivery, as well as number of damaged and unsold paper. If print quality is good and delivery is fast, as well as if there is no damaged or unsold paper, then it is said to be having more quality. Otherwise, it is said to have less quality. Now what do they say? To improve its business prospects and performance, the company is considering installation of scheduling and tracking system which involves an annual additional cost of 3 lakhs. Besides the equipment cost 4 lakhs needed to be installation of the system. Now what they wanted to do is, if they do better tracking system, all the employees will work properly so that their delivery timelines or else number of damaged units and all will be reduced it. So that they thought to have one tracking system, and where to maintain the tracking system, at least they want one system, they want one employee as well as they want one system, and they're going to pay annual salaries to that particular people, so that they're going to incur an additional annual cost of 3 lakhs, as well as to install the machinery they're going to incur 4 lakhs. Now to purchase equipment, the company is planning to utilize the proceeds of an investment fetching income of 9%. Now to purchase this machinery for 4 lakhs, what they're doing, already they invested somewhere some money. Let's say it might be FD or it might be mutual funds, where they used to get 9% return. They're breaking that, they're breaking their FD or they're breaking some mutual fund portfolio, and they're bringing money from that portfolio and they're installing this machinery. Understood, right? So this is an opportunity cost of buying a machinery. Now details regarding the present and future performance as under. They says that at present, and it means that before installation of the tracking system, on-time delivery is only 80%. As because there is a tracking system, they're looking into that. The people who are delivering, they're delivering it is on time, and it is improved to 95%. Earlier on-time delivery is 80, but now it is 95. Next, variable cost per lot of newspaper damaged and unsold is 40 rupees. This is not percentage, it is 40 rupees. See, variable cost per paper, per newspaper is 40. Sir, we discussed earlier during marginal costing first topic, variable cost of a particular product is recovered only when that particular product is sold. It means if the product is unsold and get damaged, it means that variable cost is not recoverable, right? Yes or no? It means this is the loss of, indirectly they are saying that this is loss due to unsold paper. This is the loss due to unsold paper, variable cost. Fixed cost anyhow okay. Irrespective of number of sales units, the total fixed cost is same. But if a paper is unable to be sold, then that will be the variable cost, which is loss. Because variable cost of a particular unit is recovered only when that particular unit is sold, and it cannot be recovered from some other unit. It means if this unit is damaged, variable cost of that unit has to be loss. Now fixed cost is 60,000 either way, in both the cases. Number of lots of newspaper damaged and unsold. Earlier 6,000 units were damaged and unsold, but now it is 1,000 only. It means how much cost saved here? 5,000 into 40 is a savings in cost. So 2 lakh rupees we are saving, because for each unit it is a loss due to unsold paper. Earlier the unsold paper was 6,000, but now because of this new tracking system we are able to have only 1,000 unsold units. It means 5,000 we are saving. So 5,000 into 40, which is 2 lakhs, is the savings in unsold variable cost. What did they said? It is expected that each percentage increase in on-time performance will result in a revenue of increase of 35% per annum. It means for each percentage, they are saying that 80 to 95 percentage is increasing, right? For each percentage, it means that 15% it is increasing. For each percentage, the revenue is 35,000, and required contribution margin is 40%. As revenue is increasing, we are going to produce more number of units, so that we are going to incur variable cost also more, and we are having a margin of 40% from that. After deducting the cost, 35,000 is the revenue. From that revenue, we are going to get a margin of only 40%. 60% will be the cost. Okay, it means that this will be the additional margin what we are going to get because of increasing our on-time delivery from 80% to 95%. Then what is the total here? 15 into 35,000 into 40%. So it is 2,10,000. So from savings in variable cost from damaged units is 2 lakhs, and savings in on-time delivery is 2,10,000. Our total savings is 4,10,000. 4,10,000 is the total savings. Now, draw inference from the information given above and evaluate whether Sunrise Precaution Limited should install a new machine or not. Sir, by installing a new machine, total savings is 4,10,000. Then what is the cost of installing a new machine? Annual cost of additional cost is 3 lakhs. Annual additional cost is 3 lakhs. To install this machinery, I broke one of my investment and I invested in this tracking system where I spent 4 lakh rupees. There, how much is my opportunity cost? This is additional cost, as well as opportunity cost is also considered for costing decision making, right? So it is 4 lakhs into 9%. So it is 36,000. So total it has to be 3,36,000, sir. So my total savings is 4,10,000, but my cost is only 3,36,000. As my cost is lower than the revenue or savings, so it is better to start the tracking system. Yeah. So total cost of the system is 3,36,000. That is nothing but 3 lakhs plus 4 lakh into 9%. And here it is 4,10,000. This is nothing but 2 lakhs from savings in variable cost of unsold units, plus 2,10,000 is from savings from on-time delivery. So total 4 lakh tons, net benefits is 74,000. So by installing the schedule and tracking system, the company will be able to save 74,000 per annum. Hence the company should install the new system. Clear? Okay. So that's about asset life cycle costing. Next one, decisions using probabilities. So this is one of the easiest topic. So decisions making using probabilities are nothing but, sir, usually whenever management has to make some decisions, future decisions, do all the informations are certain? Definitely not, because most of the information which we predict for the future will be always uncertain. For uncertainty things, with 100% assurance, we cannot give the values. Then what we can say? So let us say, sir, what can be the sales in the next period? I have asked my selling department. They may say that, sir, 60% chance that we are going to maintain the same sales as last year, which is, let us say, 20,000 units. So 10% chance that I may get less sales than previous year, which can be, let us say, 18,000. Definitely less than 18,000 we cannot, there won't be less than 18, but there is a chance of reducing the sales, but the chance of reducing is only 10%, and 30% chance that one of our competitor might close the business, so our sales can increase to 26,000 units if that is so. And what is the chance for that? 30% chance. So this is the way they are going to predict it. Or else if someone is asking, sir, today which team is going to win in IPL? Can you assuredly say that 100% chance this is going to be win? No, when you're talking with your friend, you may say that, so most probably, it means 70% chance that this is the team which is going to be winning. Or 80% chance, 70% chance, that is the percentage of chance only we are going to tell, because that is a future uncertain event. Future uncertain event. If such probabilities are given, then how to make a decision? Sir, here we are supposed to know only one formula. When probabilities are given, let's say 10% probability 18,000 units, 60% probability 20,000 units, 30% probability 26,000 units. And what is our estimated sales? Estimated sales has to be summation of probability of an event into sales of an event. Anything, if they're asking you what is your estimated demand, summation of probability of an event into demand of an event. If they're asking what is estimated cash flows, then summation of probability of an event into cash flow of an event. If they're asking estimated return, then probability of an event into return of an event. Whatever they give in question, if you have to, whenever you are applying a probability, your estimated value will always be equal to summation of probability of an event into value of a particular event. Understood? If you do so, then you are going to get expected profit. And these concepts just apply to the marginal concept original formulas like break even point, desired sales, MOS sales, and all. You can apply these values by calculating these estimated sales to these sales. Apply the normal marginal costing formulas and make a decision whatever they give in question. Clear? Easy. Just one formula. If you know it, this chapter will be completed. Now, what is estimated sales in this question or in this example? This has to be 80,000 into 0.1 plus 20,000 into 0.6 plus 26,000 into 0.3. That's what? Summation of sum of probability of an event into sales of an event. Clear? If you do so, then you are going to get your estimated sales. Clear? Let's move to problems. See problem number 1. For in live, you are asking which chapters are going to cover today. It is all the remaining topics which we not completed from marginal costing. As we discussed in marginal costing, there are 8 subtopics. Previously, we covered only 2. Marginal costing as main decision making techniques as well as relevant costing. Apart from those 2, all the 6 subtopics we are going to cover today. So we already done with target costing, asset life cycle costing, as well as product life cycle costing. 3 topics we already completed, and this is the 4th one. And after completion of probabilities, we are having 2 more topics apart from this. One is pricing decisions and strategies, as well as transfer pricing. Transfer pricing. So these are the topics what we are going to discuss. Okay, see sir, what they are asking. The company has estimated the following demand level. So they are estimating that 10% chance that we can have 10,000 sales units, 15% chance that 12,000, 25% chance that 14,000, 30% chance that 60,000, 16,000, and 20% chance that 18,000. These are the estimated sales demand. Now it is assumed that the selling price is 6 rupees per unit and the marginal cost is 3.5. Sir, what is marginal cost? That's nothing but variable cost. So marginal cost in the sense additional cost incurred to manufacture additional unit. That's nothing but a variable cost. And the fixed cost is 34,000. Then what is the probability that the company will get a break even? Sir, what is the chance of getting a break even? To get a break even, let us find out how many units are required. What is break even sales? Break even point is equal to fixed cost divided by contribution per unit. Contribution per unit, which is equal to fixed cost is 34,000 and contribution per unit is 6 minus 3.5, which is 2.5. So which is equal to 13,600 units. 13,600. Sir, what is the chance to get a break even? In these 2 cases, we are not going to get a break even, but in all these 3 cases, we are going to get a break even. So minimum 13,600 units we are supposed to sell to get a break even. Then what is the chance of getting break even? 0.25 plus 0.3 plus 0.2, which is 75% chance. So the first bit answer is 75% or 0.75. Next, the company will make a profit at least 10,000. Sir, desired profit. What is desired profit formula? Sir, same marginal costing techniques we are going to use it. Formulas we are going to use it. Apply those formulas to the probabilities based on the questions what they have given and tell the answer. That's it. So what is desired profit? Fixed cost plus, I'm supposed to cover 34,000 plus 10,000. Fixed cost plus desired profit divided by contribution per unit, which is 2.5. So that has to be 34,000 plus 10,000 divided by 2.5, which is 17,600. Sir, more than 17,600, what is the chance? There is only one chance for more than 17,600, which is only 20%. So second bit answer is 20% chance. Clear? Okay. Next is the illustration 2. Okay, see here. So one Limited, a manufacturing company, is preparing a budget for 2025. The parameters relating to sales, price and cost are as follows. Sales price is given as 200 per unit. Variable cost is 120 per unit. So what is variable contribution? 80 per unit has to be contribution and fixed cost is 2 lakhs. Now sales forecast has been prepared. So they're given at different percentages, different chance of getting sales also given. Now, analyze the break-even quantity. They didn't ask us probability of break-even, they just asked us what is break-even quantity. So break-even quantity is nothing but fixed cost divided by contribution per unit. So 20 lakhs divided by 80,000. So which is 25. So 80. So 25,000. So break-even quantity is 25,000 units. Okay, next. Analyze how many units are required to be sold to earn a profit of 6 lakhs. So to earn a profit of 6 lakhs, I am supposed to cover 20 lakhs plus 6 lakhs divided by 80. Which is 32,500. Next, incur a loss of 5 lakhs. So loss of 5 lakhs in the sense 20 lakhs minus 5 lakhs divided by 80. So desired profit is fixed cost plus desired profit divided by contribution per unit. So which is 18,750. Next, based on the sales forecast, identify the probability that the company can break even. Now what is the probability that the company can break even? So break even sales is 25,000. So more than 25,000 we can get a break even. So what is the probability then? 20% chance that we are not going to get a break even. So it means that it has to be 80% chance. 80% chance that we can get a break even. Next, analyze the probability to achieve the sales volumes involved in part 2. To get 6 lakhs profit, what is the chance? To get 6 lakhs profit, my sales has to be more than 32,500, which is nothing but these 3 cases only we can get it. So which is 50% chance. So 0.5 or 50%. Then minus 5 lakhs, loss of 5 lakhs. What is the probability? So I should get minimum sales of 18,750. So less than 18,750, there is only 10%. So it means that 90% chance that we can get break even. Understood, right? Sorry, 90% chance that we can get loss of 5 lakhs. Only 10% chance that my loss is more than 5 lakhs. Clear? So that's about second question. Now see problem number 3. Read it once. Okay, see here. A company had estimated the unit variable cost of a product is 10 and the selling price per unit is 15. Variable cost is 10 and selling price is 15. 5 is the contribution per unit. And budgeted sales is 20,000. Estimated fixed costs are given below. At different levels, what is the estimated fixed cost is given below. Now, what is the probability that the company will equal or exceed a target profit of 25,000 a year? Understood, right? What is the probability that we can get more than 25,000 as a profit? Clear? Sir, what is required sales to get a profit? Fixed cost divided by contribution per unit. Then what is fixed cost? So we don't know what is my fixed cost, because there are fixed cost can be 50,000, can be 60,000, can be 70, can be 80. Then what should we do, sir? To get a minimum profit of 25,000, how much my fixed cost has to be? Let's find it out that. Now what is the contribution we can get from 20,000 units? 20,000 into each unit 5 rupees, which is 1 lakh. 1 lakh is the contribution. And what is minimum profit is 25,000. Then what has to be fixed cost? fixed cost has to be contribution minus profit. Contribution minus profit, which is 1 lakh minus 25,000. That is equal to 75,000. So this is the maximum fixed cost it has to be. If the fixed cost is more than 75,000, then we won't get 25,000 as a profit. So if fixed cost is lower than 75,000, then it is okay. We can get more than 25,000 profit, which is equal or exceed, they are saying. So to make it equal, to get 25,000 rupees profit, my fixed cost should be 75,000. To get more than 25,000 profit, my fixed cost has to be lower than 75,000. Now, what is the chance of getting lower than 75,000? So, 70%, 0.7. So, 70% chance that we can get a profit more than 25,000. Clear? So, that's it. 70% is the chance. Understood, right? Now see this illustration 4. Read problem once. Okay, done. Let's see. So the managing director of Y Limited has evolved some decision making to the operating division of the firm. He is anxious to extend his process, but first wishes to assure that the decisions are taken properly in accordance with the group policy. As a check on existing practice, he has asked an investigation to be made on a recent decision to increase the price of sole product Z division. So to make it, to get more profits, they are thinking to increase the price to 14.5, but not to raise cost. That's what they are planning actually. Okay. Now the following information and estimates are available for the management of Z division. Last year 75,000 units were sold at 12 each with a total cost of 9 and 6 per variable cost, and this is the 6 rupees per variable cost in previous year. So for the year ahead, the following cost and demand estimates as given below. So variable cost, my variable cost can go up to 7, 6.5 as well as 6.2 also with these probabilities. 15% chance that my variable cost can increase to 7, 65% chance that my variable cost goes to 6.5, 20% chance that my variable cost goes to 6.7. Okay, and fixed cost. Current fixed cost is how much? For sales is total cost is 9 rupees, out of that 6 rupees is variable cost. They said 3 rupees has to be fixed and 3 rupees for 75,000 units. Then how much it will be? It has to be 2,25,000 is the last year fixed cost. So remember, whenever they give increase by 50%, increase by 25% or increase by 10%, for a variable cost apply it for per unit value, but for fixed cost we should apply for total. Sir, earlier per unit it was 3 rupees, right? Now you should not take it 3 plus 50%. No, definitely no. Whenever they give percentage increase or decrease for fixed cost, that should be applicable for the total amount, because fixed cost never depends upon number of units. It is a periodical cost and it is constant irrespective of number of units. So whenever they give increase or decrease in percentage for fixed cost, it should be always applicable for the total amount. So let us calculate given total amount. At present, how much is the total amount? So at present level of 75,000, it was 3 per unit. But if the units are increasing, the per unit cost might decrease, or if units are decreasing, per unit cost might increase. But variable cost is not a case. Variable cost per unit is constant irrespective of volume of production. Clear? So that is the reason why find out the total. To this total only we are supposed to increase the fixed cost. Clear? And then what did they said? So demanded sales estimate at various prices they are given. 13.5 is the price if it is, then 45,000 can be sales with 30% assurance, and 50% chance that there is 60% sales, and 20% chance that there will be 70,000 sales. Then if the price is 14.5, if you are having a bit extra 1 rupee, then your sales definitely decreases. With these probabilities, this will be the sales. Now what they are asking? So unit variable cost, fixed cost and demand estimates are statistically independent. What do you mean by statistically independent? Sir, if this is 7 rupee, then how much can be the fixed cost? Fixed cost can be anything, and the sales also can be anything. Sales units also can be anything. It never depends on each other. So the chance of happening of variable cost is independent to the others. So it does not say that if sales is more than 70,000 or if sales is 70, then variable cost will be 6.2. If sales is 45,000, then it is 7. Nothing likewise. They are independent to each other. So we have to take it separately. Now for this type of decision, the group has decided that the option should be chosen has highest expected outcome, at least 80% chance of break even. Sir, we should fix either a selling price of 13.5 or 14.5, sir. There are two chances. Now they are planning to fix a selling price which gives at least 80% chance of break even. It means they are not bothering about the profit. They are not bothering about which gives more profit. They are just bothering about what is the chance of getting a break even. So at which price we can get high chance of getting a break even. Clear? So to get a break even, what should we compare with? Just compare contribution with fixed cost, right? So first you calculate the contribution and take the probability of getting that contribution and calculate the estimated fixed cost. If the contribution is greater than estimated fixed cost, it means that we are getting a break even. It is lower than fixed cost, it means we are not getting a break even. Clear? So let's go and calculate contribution separately and fixed cost separately, and we can compare them. Clear? At 13.5 price, at different situations, let's find out contribution. At 14.5 also, under different situations, let's find out contribution, total contribution. Let's compare that with the fixed cost. Clear? See, question, when you are reading, it might be a complicated one, but when you are solving the question, it is one of the easiest question. So just to follow the steps what we are following. So if sales is at selling price of 13.5, let's calculate that first. So at the end, what do we require is contribution and chance of incurring that contribution. Clear? Now, sales. So contribution in the sense, from sales we are supposed to deduct variable cost, right? Sales, variable cost per unit, let us say sales, variable cost per unit, total variable cost, let's do one thing, let's take sale units first. Okay, not required. And your selling price in all the three cases will be 13.5 only. Okay, let's take sales, variable cost per unit, total variable cost, contribution, and probability. Clear? Now, when selling price is 13.5, what can be my sales? My sales has to be 45,000. Let us say, sir, when sales is 45,000, what can be variable cost? Variable cost can be 7, or variable cost can be 6.5, or variable cost can be 6.2 also. Anything can happen because they're independent to each other. When the sales is, when total sale units are 45,000, our variable cost per unit can be 7, can be 6.5, can be 6.2. Now, if it is 7, then what is my total variable cost? $3,15,000. If it is 6.5, 45,000 into 6.5, 2,92,500. Then 45,000 into 6.2, then it is 2,79,000. This total variable cost. Then what is contribution? The total sales will be 45,000 into 13.5, which is 6,07,500. From 6,07,500, deduct 3,15,000. You are getting 2,92,500. 2,92,500 minus 2,92,500, which is 3,15,000. 2,79,000. It has to be 3,51,000. This is the contribution. Sir, what is the probability of getting these contribution? What is the probability of getting this contribution? Sir, if you have to get this contribution, two things should happen. One thing is 45,000 sales has to be and variable cost has to be 7. If both these events combinedly happens, then only we are going to get this contribution. So to get this contribution, sales has to be 45,000, variable cost has to be 65,000. With this combination only we can get a sales of 3,15,000. Now what is the probability of 45,000 sales? 45,000, 30%. The probability of the sales is 0.3. Now what is the probability of these 7? 0.15. Sir, what is chance of getting 45,000 sales is 30%. Chance of getting variable cost of 7 rupees is 15%. Then sir, what is the chance of happening combinedly both the units? That is called as joint probability. That is called as joint probability. Sir, what is joint? Then how much is the joint probability, sir? Let me take one example. Sir, if you take a die, if you throw it, what is the chance of getting 5? If you take a die and throw it, then what is the chance of getting 5? Only one chance out of total 6 chances. Then the probability of getting 5 is 1/6. Now sir, you have taken one more die, the other die, and you have thrown it. What is the probability of getting 5? For that die also the probability is 1/6 only. Now you have taken 2 dice, sir. You have taken both the dice and you have thrown it. What is the probability that both the dice gets 5 and 5? Then what is the probability? Then what is the total number of outcomes from dice? When you throw 2 dice, what is the total number of outcomes? It can be 1 1 1 2 1 3 1 4 1 5 1 6 2 1 2 2 2 3 2 4 2 5 2 6 3 1 3 2 3 3 3 4 3 5 3 6. Likewise, first die can have 6 chances. Second die has 6 chances each time. If the first die is 1, there is 6 chances. If the first die is 2, there is 6 chances. If the first die is 3, there are 6 chances. Likewise, if we take it totally, 6 into 6, 36 chances we are going to have it. Out of 36 chances, how many chances has both the dice have 5? Only one chance. So 5 5, only one chance. It is nothing but multiplication of individual probabilities. The joint probability is always just multiplication of individual probabilities. So the probability of getting 5 for the first die is 1/6. The probability of getting 5 when you throw the second die is 1/6. Then if you take both the dice, if you throw it, the probability of getting 5 in both the dice has to be multiplication of individual probabilities, which is nothing but 1/36. Clear? Or if you take a toss, very simple example. If you take a coin, if you toss it for the first time, what is the probability of, or for the first coin, what is the probability of getting head? 1/2. Then if you have taken the second coin and you toss it, what is the probability of getting head? That is also 1/2. Now you take the 2 coins, then what is the probability of getting both the heads? Sir, how many chances we are having? 4 chances, sir. The results can be head head, head tail, tail head, tail tail. Now what is the chance of happening both the heads? That's nothing but 1/4 only, which is nothing but multiplication of individual probabilities. Understood? Similarly, here to happen both the events, the probability has to be 0.3 into 0.15. So that is equal to 0.045. Clear? Then what is the probability of happening? What is the probability of 6.5? 0.65. The probability of 6.2 is 0.2. Then our joint probability has to be 0.3 into 0.65, which is 0.15. 195. Okay, then what is the probability of 0.3 into 0.2? It has 0.06. Clear? Now, sir, when sales is next, when sales is 60,000 units, when sales is 60,000 units, still the variable cost can be 6, 7, 6.5, 6.2, anything can be. Then what is the probability of getting 60,000 sales is 0.5. Now what is the contribution now? What is total variable cost? 60,000 into 7, 4,20,000. Then 60,000 into 6.5, 3,90,000. Then 60,000 into 6.2, 3,72,000. Now what is contribution, sir? Contribution is 13.5 minus 7 is contribution per unit, 6.5 into 60,000. That is equal to 3,90,000 is the contribution. Clear? Next, 13.5 minus 6.5, 6 into 60,000, 3,60,000. Then 13.5 minus 6.2 into 60,000, then 4,38,000. Sir, what is the joint probability? 0.5 into 0.15, which is 0.075. 0.5 into 0.65, which is 0.325. Then 0.5 into 0.2, then we are going to get 0.1. So this is the way to write the probabilities. Likewise, the probability of getting different levels of contributions. Likewise, we are going to fill this one. See here, this is the total contribution and the joint probability. You don't need to bother about cumulative probabilities anyhow, not required, nothing, forget about that. So contribution and probability, when the selling price is 13.5, do it similarly, as well as when the selling price is 14.5, also do it similarly. After doing, then calculate what is estimated fixed cost. See sir, the fixed cost can be increases by 50%, can be increases by 20%, can be increases by 10%, they are saying, and current fixed cost is 2,25,000. So it means that calculation of estimated fixed cost. Got it? Probability and fixed cost. Now they says that 30% probability their fixed cost can be 2,25,000 plus 50%, which is equal to 2,25,000 plus 50%, which is 3,37,500. Next, 50% probability that the fixed cost increases by 25%. So 2,25,000 plus 25%. So it is 2,81,250. Then 20% chance that it is increased by 10%, 2,25,000 plus 10%. It is 2,47,500. Now what is estimated fixed cost? Estimated fixed cost is simply summation of probability of an event into fixed cost of an event. So that is nothing but 3,37,500. 3,37,500 into 30%, 1,01,250. plus 2,81,250 into 0.5, which is 1,40,625 plus 2,47,500 into 0.2, 49,500. Now this is the total estimated fixed cost. It's 1,40,625 plus 1,01,250. So which is 2,91,375. 2,91,375 is the estimated fixed cost. So to get a break-even point, they did ask us to get a break-even point, right? So to get a break-even point, my contribution has to be more than fixed cost. Let's check it. Let's check with that. My contribution has to be more than fixed cost. If you check it is 2,91,375 is the fixed cost. My contribution is greater than that, greater than that, greater than that. So when the selling price is 13.5, in all the cases, my profit is greater than fixed cost. So here 100% break-even chance. Here we are going to get 100% break-even. Clear? Then what if the selling price is 14.5? Sir, my fixed cost, estimated fixed cost is 2,91,375. So here I didn't get, here also I didn't get, here I didn't get, and from all these cases I get. In all these three cases, this is called as the probability where we cannot get contribution. So add all those three probabilities: 0.045, 0.195, 0.06, which is nothing but 0.3, which is nothing but 30% chance that we are not going to get a break even. So only 70% chance that we are going to get a break even. But what is question is giving us? We have to choose it only when we get more than 80% of the contribution. So as we are getting less than 80% of the contribution, 14.5 is not an ideal price. 13.5 is the ideal price to be kept. That should be the conclusion we are supposed to make it. At 13.5 we are going to get 100% chance break even. At 14.5 we are going to get only 70%. Therefore the selling price has to be 14.5. And also they are asking us attitude towards risk things. Obtain the group attitude towards risk as the evidence by the guidelines is. Then you can read this one. Just it is the group seeks to minimize the downside risk, maximizing its return. It is some extent risk adverse because it is prepared to take some risk, 20% of the risk. It is always sought to maximize returns, ignoring the probability of failure. It would be risk neutral. What they are saying that this company is risk, it's not a risk neutral, it is a risk averse only, because it is trying to take 20% risk. It's not away straight away, it is not ignoring the risk. It is trying to take 20% of the risk to do the business. So that's what the point they are telling us. Clear? So that's about decisions using probabilities. So just find out the probability. Just only one formula we are going to use it under probabilities. It is summation of estimated value. It might be estimated sales, it might be estimated demand, it might be estimated cash flows, it might be estimated returns or anything. Whatever it might be, the formula is only one. Estimated value is summation of probability of an event into value of an event. Clear? Based on that, apply normal marginal costing techniques formulas and then make a decision. Even for this last problem what we solved also, we have used marginal costing technique only. They are saying that we want 80% chance of break even. At least minimum 80% break even we are supposed to get to make a decision, or to consider whether the particular product can be started or not. Clear? Then what is the formula we used it? So to get a break even, my contribution has to be greater than fixed cost. So I have calculated contribution at different levels, and I have calculated probabilities of getting those contributions, and separately I calculated what is my estimated fixed cost. Then I am comparing my contributions with those estimated fixed cost. If contributions are greater than estimated fixed cost, then we are going to get break even. If it is less than that, then we are not going to get a break even. Clear? Okay. Now, next topic is pricing decisions and strategies. So, this chapter theory is nothing to do with the problems, and these chapter problems will slow. Everything is based on marginal costing, basic formulas only. Straight away we can move to problems actually, because theory is nothing to do with the problems. Clear? Okay. So read illustration 1. We're just going to use marginal costing techniques only to solve all these problems. Okay. See illustration 1 once. Okay, done. Okay, let us see now. Now, what do they say? A review made by the top management of Sweet and Struggle Limited, which makes only one product, of the result of the first quarter of the year revealed the following. For getting the results of the first quarter, they have came up with these values. Sales in units is 10,000, loss is 10,000. They got a loss of 10,000, and fixed cost is 30,000 rupees, and variable cost per unit is 8 rupees. So for the whole year it is 1,20,000, and for quarter it is 30,000. That's what they are saying. Now, the finance manager, who feels perturbed, suggests that the company should at least break even in the second quarter with a drive for increasing sales. As they are getting losses, the sales manager is feeling that at least in the second quarter we have to get a break even. Now, what is he suggesting? Towards this, the company should introduce better packing, which will increase the cost by 0.5. So if you have to increase the sales, what he is saying that increase the packing, have some luxury packing. Use the same product, nothing problem. But if you give some luxury packing, customers may feel that it is somewhat a luxury product or somewhat esteemed product, and they may buy it so that our profits can increase. So that's what they are expecting. But what a sales manager is saying, sales manager has an alternative proposal. For the second quarter, additional sales promotion expenses can be increased to the extent of 5,000. A profit of 5,000 can be aimed during the period to increase with increased sales. So what is financial manager is saying? Have some luxury packing and sell it. But sales manager says that okay, no need to change any packing. Give somewhat more promotions, spend more money on advertisement so that we can increase our sales. But the production manager feels otherwise. He says that to improve the demand, the selling price per unit has to be reduced by 3%. He says that you don't need to do anything, just decrease selling price by 3%, then you can make some profits. So as a result, the sales volume can be increased to attain a profit level of 4,000 for the quarter. What they are saying here. The managing director asks you as a cost accountant, evaluate the three proposals, calculate the additional sales volume that would be required in each cases. In each of the cases, what is the additional volume we are supposed to sell in the second quarter? That's what we are supposed to find it out. Let's see here. Now, first case, Sir, break-even volume, what is the formula? Fixed cost divided by contribution per unit. Fixed cost divided by contribution per unit. What is the formula for desired profit? Fixed cost plus desired profit divided by contribution per unit. These are the two formulas which we are supposed to solve this problem. Break-even point is fixed cost by contribution per unit. Desired profit sales is fixed cost plus desired profit divided by contribution per unit. Okay. Now first one. Sir, they want a break-even. Now what is variable cost? 8 plus 0.5. Total variable cost will be 8 plus 0.5 per unit for introducing luxury packing. So totally 8.5 will be the variable cost. Then what should be break-even sales then? Break-even point sales is equal to fixed cost, which is 30,000, divided by contribution per unit. Sir, we want contribution per unit. If it is so, I wanted to know how much is the selling price, right? So what is the selling price in previous case? Sir, if you get a loss of 10,000, fixed cost is 30,000, then what is my contribution earlier? 20,000. Fixed cost plus profit is equal to contribution. As we got 20,000 contribution, we try to recover 30,000 fixed cost and we end up with getting loss of 10,000. So contribution is 20,000, contribution per unit is 2 rupees. Contribution per unit is 2 rupees earlier, and so sales was variable cost per unit plus contribution per unit, that has to be the selling price. Clear? Earlier if contribution is 2 rupees, now if variable cost is increasing by 50 paise, so total 10 minus 8.5, now my contribution has to be 1.5. With revised contribution per unit is 1.5. So totally 30,000 divided by 1.5, which is 20,000. So based on his proposal, to get a break-even point, totally we require 20,000. But in question they are asking us to find out additional sales volume. So existing sales is 10,000, additional is 20,000. So the first bit answer is 10,000. Additional sales is 10,000. Clear? Next, second, sales manager. What is sales manager is telling us? He says that to increase fixed cost, promotion expenses by 5,000 is nothing but he is telling us to increase the fixed cost, not per unit one, total amount, so that he is asking us to increase the fixed cost. So how much is earlier fixed cost? 30, now it is 35, and so that he is planning and he is saying that we can get profit of 5,000. So to meet his expected profit, how much should be our sales? What is the formula, sir? Fixed cost plus desired profit divided by contribution per unit. So what is fixed cost now? 35,000. Profit is 5,000 and contribution is 2 rupees only. Contribution is not changing. Why? Because variable cost is not changing, selling price is not changing. So it has to be again 20,000 units. Now if 20,000 units and more than 10,000, 10,000 once again. Second bit answer is also 10,000. Now sir, third bit answer. Sir, if selling price is decreasing by 3%, they are saying, what is revised selling price then? Earlier it was 10. So revised selling price has to be 10 minus 3%, which is equal to 9.7. 9.7 has to be the revised selling price. Then what has to be the contribution per unit? Contribution per unit has to be 9.7 minus 8, which is variable cost per unit is 8, so which is 1.7. This is contribution per unit. So to get 4,000 profit, how many sales he has to do? Fixed cost 30,000. So fixed cost 30,000 plus profit of 4,000. These two we have to cover with 1.7, where it is also 20,000, and for this also answer is 10,000. In all the three cases, additional sales has to be 10,000, 10,000, 10,000. Clear? Okay. Now, read this question. Sir, it's one of the important one. This is also a different, it's a small different question. They have given for 14 marks in previous exam. Just check with that. They might give similar kind of questions for you very frequently. Read it properly and try to understand what they are giving you. Okay, see here. Forward and Foundry Limited is feeling the effects of this general recession in the industry. So they are saying that they are having some recession in the industry, and its budget for the coming off year is based on the output only 500 tons of the castings a month, which is less than half of its capacity. Now they are saying that due to recession, they are able to use only half of the capacity, even not even half, less than half of the capacity, and they are producing only 500 tons. Now the price of the casting varies with the composition of metal and the shape of the mold, but they average 175 a ton. So anyhow they says that each mold is selling prices 175. Different selling prices are there, but on an average they are selling it for 175, so that we can take selling price per unit as 175. That's fine, right? So the following details are from the monthly production of 500 tons level. So to produce these 500 tons, these are the various costs they have given. Labor 10,000, molding 16,000, sorry, melting and pouring 16,000, molding is 6,000, and 4,500 for cleaning and grinding. Similarly, they are given variable overhead and fixed overhead also. Totally 18,000 rupees, 26, 9,000, 6,500 they have incurred. Now, see, listen properly. Labor and other overhead rate per direct labor hour is given as 9, 6.5. See, labor and overhead rate per direct labor hour, it's nothing but labor and overhead divided by number of labor is equal to 9 they have given, and labor and overhead cost is 18,000 and rate is 9 rupees. Then how about number of labor? Then that implies number of labor hours has to be labor and overhead cost divided by 9 labor rate. So indirectly they given number of labor hours for us. Then what is number of labor hours for us? Number of labor hours are 18,000 by 9, that is 2,000. 26,000 divided by 6.5. 26,000 divided by 6.5, which is 4,000. 9,000 by 6, which is 1,500, and 6,500 by 5.2, which is 1,250. So these are the number of labor hours. Okay, next. Operations at this level has brought the company to brink of its break even. So it just came nearer to the break even. It means they have not even getting break even, they are getting losses. Now it is feared that if the lack of work continues, the company may have to lay off some of the most highly skilled workers, whom would be difficult to get back when the volume pickups upon later. So what the major fear for them is that if the same lack of work continues, they have to remove some of the skilled labor. But the problem is that whenever they get work in future, they cannot get back those skilled workers. Now no wonder the works manager at this juncture welcome an order for 90,000 castings. At that situation, now works manager bought a new order for making 90,000 castings. Got it? And each weighs 40 lbs to be delivered on a regular schedule for the next 6 months. So regular schedule for the next 6 months, it means per month it has to be 90,000 divided by 6, 15,000 castings they have to be delivered. Okay. As the immediate concern of works manager is to keep up this workforce occupied, he does not want to lose this order and is ready to recommend a quotation on a no profit no loss basis. See, anyhow their labor are vacant, and they wanted to quote for this order for this 90,000 castings. They have to give price rate. While fixing the price, not to lose this order, is giving at break even. So no profit no loss basis only is going to give. So it means that we have to find out the total cost of making these additional 90,000 castings divided by 90,000, then we are going to get selling price per casting. Now materials required would be 1 per casting after deducting the scrap credits, the direct labor hour per casting would require for each department would be. So it means that for making that extra castings, direct labor hour for each castings would be 0.09, 0.15, 0.06 and 0.06. Okay, next. Variable overheads would bear a normal relationship with the labor cost in the melting and pouring department and in the molding department. Sir, in the melting and pouring department and molding department, variable overhead changes rationally relatively only. And how much is variable overhead per hour earlier? Here it is 2000 hours, means here it is per hour 1.5, here per hour 0.25, here 1000 divided by 1500, so 2 by 3, and here 1000 divided by 1250, 0.8. Now these 0.25 and these 2 by 3 will be continued, they said. Next. In core making, cleaning and grinding, however, the extra labor requirement would not anticipate by the proportionate increase in variable overhead. But in core making as well as cleaning and grinding, it is not going to be incurred same as earlier, which is 1.5 and 0.8. Then how does it incur? Variable overhead would be increases by 1.2 for every additional labor hour in the core making and by 30 paise for every additional labor hour in cleaning and grinding. Sir, this sentence is very much important. Listen very carefully. Variable overhead would increases by 1.2 for every additional labor hour. Earlier, how much is cost per labor hour? 1.5. Now it is increasing by 1.2 for every additional labor hour. Sir, it means that for the extra work, is that per hour 1.2 or per hour it is 1.5 plus 1.2? What it is? Is that 2.7 or 1.2 for the additional one? So which one I am supposed to consider? Clear? Listen very properly. Sir, they have given variable overhead, not variable overhead per hour will increase. It means that earlier how much is variable overhead? 3000 rupees. Earlier variable overhead is 3000 rupees. These 3000 rupees will increase by 1.2 rupees per every additional hour. Clear? This is how we have to make it. It means that for additional things it is 1.2, not 2.7. For additional hours it has to be 1.2, not 2.7. See the sentence once again. It is, if the same question gives you variable overhead per hour, variable overhead per hour would be increases by 1.2 for every additional labor hour, then it has to be 2.7. But they have not given that. So what they have given? Variable overhead cost. Here, variable overhead would increase by variable overhead. How much is variable overhead now? 3000. Total amount is increases by 1.2 rupees for every additional labor hour. It means that per extra hour we are going to incur only 1.2. 2.7 no, 1.2 is the correct one. If we miss that just per hour thing, we might mistake and take 2.7, which might be wrong. Understood, right? So it has to be 1.2, not 2.7. Similarly, 30 paise for the cleaning and grinding. So in the place of 8.3, we are going to get 30 paise, which is 0.3. Clear? That has to be the variable cost for the additional hours. Okay. Then standard wage rate are in the operations in each department and no labor variance are anticipated. Okay, for wage rates, however we are having the labor wage rate now, the same wage rates will be continued. It is not going to be increased, that's what they said, or decreased. Same will be maintained. To handle an order as large as this, certain increase in factory overheads would be increases amounts to 1000 a month for all the departments put together. It means that it is not individual departments or all the departments put together. Fixed cost is increasing by plus 1000 rupees. Next, for order evenly for the 6 months, 1000 rupees a month for all the 6 months. So per month it is 1000, for 6 months it has to be 6000. Next, we are required to prepare a revised monthly labor and overhead cost budget reflecting the additions of this order. So reflecting the additions of this order, they are asking us monthly report. So let us say, let's take working note 1. First, core making, melting and pouring, molding, cleaning and grinding. So these are the 4 departments. First, what is total labor and overhead cost at present? 18,000, 26,000, 9,000, 6,500 divided by rate per hour, which is 9, 6.5, 6 and 5.2. Then we are going to get number of hours. Number of hours 2000, 4000, 1500 and 1250. Now what is labor cost per hour? Labor cost per hour is 10,000. It is the total cost, so it has to be 10,000 by 2000, which is 5. The next 16,000 by 4,000, 4. So next 6,000 divided by 1500. So 4 once again. Next 4,500 divided by 1250. 3.6. And for additional labor are also, it will be the same. That's what they given. Labor cost per hour, it is not changing. Only variable overhead only it is changing, they said. Okay, next what is existing variable overhead per hour? That is nothing but 3000 divided by 2000, which is 1.5, 0.25, 2/3 and 0.8, 0.67 or 2/3 or 0.8. Clear? This is the what. Now what is variable overhead per hour of additional hours? For additional hours, here it is 1.2 and here it is 0.3, and these two things it will be the same, 0.25 as well as 2/3. Clear? That is the working note. We gathered all the data. Now let's find out. Let's see here. What did they asking us? Prepare a revised monthly labor and overhead cost budget reflecting additions of the order. It means that additions we have to show it separately. Let us see here. Let me draw it. Monthly budget reflecting additionals. reflecting additions. Now it has to be core making, melting and pouring, molding, cleaning and grinding. Total. First, labor cost, existing labor cost. Existing labor cost. So already given in question, which is 10,000, 16,000, 6,000, 4,500. So totally 36,500. Next, additional labor cost. So to find out additional labor cost, let's go for additional number of laborers, additional laborers. So additional laborers, they says that for each, the direct laborer per casting for each is this one, and as we are drawing monthly one, I want it for 15,000 units, right? So it has to be 15,000 into 0.09. So based on that only we are going to get additional number of laborers. That also has to be calculated in working note. So 15,000 into 0.09, which is 1350, is the additional number of laborer required. Next, 15,000 into 0.15, which is 2,250. Then 15,000 into 0.06, 900. And next one also same, 900. Now what is labor cost per hour? It is 5 rupees. So it has to be 1350 into 5. It has to be 1350 into 5. So 1350 into 5, 6,750. So we are not calculating separate, we are not calculating total combinedly, because they told us to show addition separately, reflecting the addition separately. That is the reason why in every cost we have to show existing labor cost and additional cost separately. Similarly for overheads also. So got it right? Similarly you take it for all the things. So this is how to calculate a statement, sir. You see here, labor, existing labor, labor for the order, 10,000, 16,000, 6,000 and 4,500. And for the new order, it has to be 1350 into 5, which is 6,750, which is 6,750. Next case, 2,250 into 4, 2,250 into 4, which is 2,000 into 4, 8,000, 250 into 4, 1,000, total 9,000. So 9,000. So likewise we are going to do it, and we are going to make a total. Clear? Next, variable overheads. Similarly, variable overheads also. Variable overheads we have to take like this, 1350 into 1.2. So this is variable overhead for additional laborers. Existing, okay. First, this is variable overheads. All this you carry from the existing quotient. Existing values. Just carry from the existing values. Additions whenever you are taking, additions whenever you are taking, this has to be 1350 into 1.2. That has to be 1350 into 1.2, and this has to be 2250 into 0.25, 900 into 2/3, 900 into 0.3. That's how we have to calculate this one. Next, fixed cost directly we carry from the question, and then additional fixed cost only add to the total. Additional fixed cost only add to the total, because combinedly we are going to incurring. Clear? So by adding all those things we are going to get the total cost. This is the total cost, add additional fixed cost, and this has to be the total cost, monthly budget. Understood, right? And then what they're asking, second bit. So determine the lowest price at which the quotation can give for the 90,000 castings without increasing a loss, incurring a loss. Sir, without incurring a loss, how much should be the price for the 90,000 castings? Sir, for 90,000 castings, what is the additional cost divided by 90,000? Then you can get it. How much is the per unit? If you see here, sir, take only these totals. Take only this total. Labor for the new order is 3,240. Is 3,240. For new order, total additional labor cost is 3,240. And variable overhead. So, okay. Totals they have not taken. So no, we have to take the total. You have to take these columns only for the new order columns. What is that? Labor for the new order is 6,750 plus 9,000 plus 3,600 plus 3,240, which is 22,590. So labor cost is 22,590. Next, variable overhead. Variable overhead for the new order, which is, so whenever you're drawing, you fill the total column also, then we can directly carry the values easily. 1620, 563, 600 plus 270. So which is 3,053. This has to be the variable overhead. And fixed cost is additionally, because of this order we are incurring only 1,000. Fixed overhead, because of this order we incurred only 1,000. This is the total cost for 15,000 units only, because this is monthly. 15,000 units only. So it has to be 22,590 plus 3,053 plus 1,000. This is the total cost 26,643 divided by 15,000. So it has to be 1.7762. This has to be the price per casting. Understood, right? And price per casting and quotation should be given for the total 90,000 casting, then into 90,000. Into 90,000, it is 1,59,858. $1,59,858. Okay. There is one thing which we missed is material cost. Material required per casting is 1 rupee. That we have not taken. So add that 90,000 rupees. Add that 90,000 rupees. That has to be the total. 1,50,958 plus 90,000. So which is 2,49,858. So material cost and labor and overheads from the total cost, how they did is, from this total cost of 86,143, they have deducted the existing total cost, existing all this total cost. So from the total cost, if they have deducted the existing total cost, then we are going to get the cost only because of new order, which is 26,643. That's what we got it, 26,643. So what we did is we added the additional cost and we make it the total, and what they did from the total cost, they deducted from the existing cost, so that they got the total cost. Clear? Then to that they added material cost plus this is the total cost, and that is for 1 month. How much is for 6 months? So into 6 they have taken. Instead we have taken material cost of 90,000 and we got the same answer. That any way you can represent it. Either way you can represent it. So that's about pricing decisions. Clear? Okay. Let's see the last topic, transfer pricing. Okay, it's very important topic, transfer pricing, because without a transfer pricing, if you see past exam papers, there is no question paper from December 2023. From change of syllabus, December 2023, they are keeping from December 2022 syllabus. From that December 2023 to December 2025, no paper is given without transfer pricing. Got it right? Now, most of the people thinks it is a complicated one, but it is easy when you have certain points in your mind. Let us keep what are those points. So transfer pricing in the sense, a price which is fixed by one division to the other division of the same organization when they are transferring goods internally. Clear? What does it mean is, let us say there are division A and division B. Whenever one division is transferring goods to the other division, at whatever the price they are transferring, it is called as transfer price. Sir, if question asking you to calculate transfer price, it is per unit. If the question is asking you to calculate transfer value, it has to be per unit into number of units transferred. Clear? Sir, for division A, it is transfer value, and for division B, it is called as transfer cost. It is transfer cost. B is incurring a cost and A is getting some value by transferring the goods. Now, sir, while transferring, let us say division A has incurred a cost of 100 per unit. They're adding a margin of 30 rupees, and for 130 if they are transferring, let us say, then what is the cost for division B? 130. They are adding 70 rupees more cost to convert that semi-completed units into finished goods, and the total cost is 200 per them, and they are selling for 250 rupees to the outside customers. Then what is the profit recognized by division B? Division A has recognized a profit of 30. Division B has recognized a profit of 50. Sir, as a whole organization, how much is the profit? It has to be 80. It means that we have to keep this in mind. The total profit recognized by the whole company, or the total profit, the profit of the whole organization, is nothing but sum of the profits recognized by individual divisions. Sir, if you think as a company's perspective, what is the total cost incurred for the company? In division A, they incurred 100 rupees, they spend 100 rupees. In division B, they spend 70 rupees. So for the whole company, what is the cost? Has to be 170. Has to be 170. So this transfer price and the margin, whatever internally we are keeping, that is just a notional amount. That is not a real value. That is not a real value, though. That is just to evaluate the performance of individual divisions. That is the only reason why we are having transfer price. Other than that, for the whole company, the total cost is 170 and we are selling for 250. So which is nothing but 80 is the margin. 80 is the margin. Sir, when they are transferring from division A to division B, how the transfer price is fixed? It depends upon many methods. Let us see one by one. First thing, sir, division A is having a capacity. Let us see one by one, and situations also. Division A. So division A is having a capacity to produce 10,000 units. but their maximum sales demand for the outsiders is 5000 units. So for 5000 units anyhow it is vacant. Now one of the division is coming, division B is coming to division A and they're asking for getting the 3000 or 4000 units. Anyhow division A premises is anyhow vacant, right? So that they can charge marginal cost. It's nothing but cost to incur or cost to produce additional units. Fixed cost is not going to be incurred. Marginal cost in the sense variable cost. So for division B, to produce units, how much is the cost division A is going to incur? Only variable cost. Why? Because anyhow they are having vacant capacity. Fixed cost will be the same anyhow, irrespective of number of units you produce. You are going to incur only variable cost. So variable cost is the right target price to be fixed. But if division A wants a margin, marginal cost plus desired profit. That has to be clear. So let us go with another situation. Sir, what if division A can sell 10,000 units to the outsiders? All the 10,000 units they can sell for outsiders. Now if division B comes to division A and asking for 1000 units. Sir, if division A has to supply 1000 units to division B, it has to forgo contribution what they are getting from the outside public, so that their minimum transfer price will be the market price what they are selling for outsiders. But so there is one more thing here. So let us say market price is 100. Manufactured market price is 100, but to sell to the outsiders they have to do some special packing as well as they have to do some marketing things which they no need to do for internal transfer. Let's say packing and selling and distribution cost is 20 rupees. Then what is the net selling price for A? 80 rupees only. So at 80 they can transfer for division B because that is their marginal cost. Sorry, opportunity cost. That will be their opportunity cost so that they can fix 80. Clear? So this is the minimum price what division A can be accepted. Sir, but what is the maximum price division B has to accept? What is the maximum price division B? Let us say, sir, the same unit if they buy from outside, if the cost for them is 120 rupees, then what is the maximum price division B is willing to pay? 120 rupees only. The maximum price division B is willing to pay is only 120. So what can be the transfer price now? Anyway between 80 to 120. The range can be between 80 to 120. Sir, in question if they are asking you to fix the selling price without giving any additional information, then calculate minimum price acceptable by division A, maximum price willing to pay by division B, and you can tell the range. Transfer price can be any range between 80 to 120. Clear? Understood? Only these points if you are aware of, then you can do all the questions of transfer pricing. Sir, again I will repeat once again, listen. Sir, while you are fixing transfer price, your question itself will guide you very properly what should be the transfer price. Clear? That is one point. If question is not telling you, then if division A is having additional capacity and if division B is asking for producing by utilizing only such additional capacity, then the transfer price is always depends upon the marginal cost, variable cost. But if division A has to manufacture for a division B for stopping for external sales, by stopping the external sales, then they normally fix transfer price based on the external market price. Clear? But division B will never agree to fix a transfer price on and above what they can get it from outside. That is the maximum price what they are willing to pay. If these 3 points if you are aware of, you can solve all the questions. And one thing, that company's profit is always equal to profit recognized by individual divisions. Sum of the profits recognized by individual divisions. Clear? And one more thing, last point is, sir, whenever you are fixing a transfer price, your whole company should not be impacted. Your whole company cannot be impacted. Let me take one example so that you can understand. There is division A and division B. Division A can sell for 100 rupees to the outsiders. So that is the reason why division A says that for division B, I can transfer only for 100. I can transfer only for 100. Less than 100, I cannot transfer. That's what they are saying. So the variable cost for division A is 70 rupees. Then what is the margin they can get it from outside? Then margin is 30 rupees what they can get it from outside. Clear? So division B can get the same good from outside at 90 rupees. At 90 rupees, so that division B says that 100 I am not going to accept it. 100 I am not going to accept it. Clear? Now, division A says that I definitely require 100 only. Division B says that no, I cannot buy it at 100 because from outside I can get it for 90 rupees. So if this is the situation, if division A is selling for outside, they're gaining a margin of 30 rupees. But division B has to spend 90 rupees to get the same unit. Clear? And what is the cost of manufacturing internally? Only 70 rupees. Only 70 rupees. So the cost of manufacturing is 70, but from the outside they are getting it for 90 rupees. It means 20 rupees excess they are incurring. Or let us make it as variable cost is 60. No. Let's make it variable cost as 85. Variable cost 85 and margin is 15. If this is the situation, sir, variable cost is 85, but they can sell it outside for 100 rupees. So that division A wants 100 rupees. That's what they're strictly saying, that if you give me 100, then only I can transfer it internally. Otherwise, I will sell it for outsiders. That is the argument which is giving. So division B says that no, okay then, I don't want it. I will buy it from outside, where I can buy it for 90 only. If you can fix less than 90 only, I can accept it. 90 or less than 90, I will accept it. But you are fixing more than 90, so I do not accept it. That's what B is arguing. So now what they are doing, A is selling for outsiders and B is also buying from outsiders. They are doing with external parties because internal negotiations are not performed well. But sir, by selling outside, division A is getting a margin of 15 rupees, but division B has to spend 90 rupees, where internal variable cost is only 85 rupees. Extra cost they have to spend it. Extra cost they have to spend it, where as a whole organization, which they may lead, or which may end up with losses. So that is the reason why should be a goal concurrence. There should be a goal concurrence. Sir, what is that goal concurrence? Overall, company should not be impacted. Whenever you are fixing the prices, even though the transfer price is not acceptable, but still sometimes thinking in the perspective of the whole company, it is better to take at 100. It is better to take at 100. Clear? Okay. Now let's move to the problems quickly. There are 4 problems, I think. All different 4 problems I have taken. If you can solve these 4 problems, all the transfer pricing will be covered. Okay. So read this question once. Okay, see here. Transfer Limited has two processes, preparing and finishing. The normal output per week is 7,500 at a capacity of 75%. Transfer Limited had production problems in preparing and requires 2,000 units per week from of a prepared materials for their finishing process. So there are two processes, preparing process and finishing process. Finishing process wants goods from preparing process, which is 2000 units per week. Okay. Now the existing cost structure for one prepared unit for Transfer Limited at the existing capacity as follows. The department or the division whoever is transferring, for them these are the cost what they are incurring. Material cost is 2, labor cost is 2, out of that variable is 50. Let's find out variable cost first. Material cost is 2 rupees is the variable. Labor cost is 1 rupee as variable. Overhead is also 1 rupee. And total variable cost is 4 rupee. And total cost is 8 rupees. Total cost is 8 rupees, variable cost is 4 rupees. Okay. The sales price of a completed units by transfer it is actually. The sale price of a completed unit is 16 rupees and a profit of 4. Then what is total cost? For both the divisions combinedly, total cost has to be 16 minus 4, which is 12. 12 rupees is the total cost. Out of that, 8 rupees is incurred by preparing division. It means remaining cost of 4 rupees cost for finishing. 4 rupees is the cost for finishing. That's what they told. See here, they given information of cost structure of 1 unit and variable cost is 4, total cost is 8. But for the Transfer Limited, the overall finished product, when we are selling it to the outsiders, we can sell it for 16 rupees at a profit margin of 4 per unit. Then what has to be the total cost? Selling price minus profit per unit, then we are going to get the total cost. Out of total cost of 12 rupees, if 8 cost is for preparing and 4 cost has to be for finishing. Okay, next. Construct the effect on profits of Transfer Limited for 6 months. I wanted to make profit for 6 months for 25 weeks. That's nothing but for how many units? 2000 into 25, which is for 50,000 units. They wanted to know the profits of Transfer Limited, the party who is transferring, of supplying units to Transfer Limited with the following alternatives per unit. If these are the different alternatives to fix the selling price, transfer price, then what is the profit recognized by Transfer Limited? First one, marginal cost. Marginal cost in the sense variable cost 4 rupees. Sir, whenever we have to produce additional units for the other division with other division of the same organization, what is the additional cost we are going to incur? 4 rupees only, variable cost only, fixed cost anyhow we are not going to incur. So the additional cost what we incurred is 4 rupee and we are also transferring at 4 rupee, then profit recognized will be 4 minus 4, 0. So for 50,000 also it will be 0. Per unit 0, for 50,000 units also 0. See here. When transfer price is 4, profit per unit also will be, the profit per unit will be 0. So profit per 50,000 units also it will be nil. Clear? But for marginal cost plus 25%, then what should be the transfer price? 4 plus 25%, which will be equal to 5. When transfer price is equal to 5, cost of making is 4 rupee. So profit per unit is 1. Profit per unit is 1. So for 50,000 units it has to be 50,000. For 50,000 units it has to be 50,000. Next, marginal cost plus 15% return on ROI, 15% return on capital. That's nothing but ROI is 15% and capital is 20 lakhs. So then what is our profit per unit then? Listen very properly. See, 20 lakhs is the capital we have introduced and I want a return of 15%. Sir, how much is the profit I do require? 3 lakhs profit, which is 3 lakhs is the profit which I do require. But this rate is per annum. I am doing statement for 6 months. Then in 6 months, how much is the profit I am supposed to recover ROI? into 6 by 12, which is 1,50,000. And these 1,50,000, I have to get it from 50,000 units, and per unit I have to recognize a profit of 3 rupees. If per unit, if I have to recognize a profit of 3 rupees, then what should be my transfer price? It has to be manufacturing cost is 4 rupees. Manufacturing cost is 4 rupees. Transfer price is 3 rupees. Totally 7 should be the transfer price. Clear? Here. So transfer price is 7. Per unit profit is 3. Total profit is 1,50,000. Clear? Okay. Next one. Existing cost, sir. Existing cost is nothing but 8 per unit. Existing total cost 8 per unit. If transfer price is 8, what is profit margin? The cost, additional cost what we incurred to manufacture that unit is 4. So that profit margin has to be the 4. Then see here. Existing cost 8. Profit per unit is 4. For 50,000 units it has to be 2 lakhs. Clear? Okay. Next. Yeah, this point see very carefully. Existing cost plus proportion of profit on the basis of preparing cost divided by total cost into unit profit. So existing cost is 8 plus unit profit is 4, that into preparing cost, which is 8 rupee. Preparing cost is 8 rupee divided by the total cost. Total cost is nothing but 12 rupee. 8 by 12. So this is the profit, we are supposed to recognize it. That's what they're saying. So which is nothing but our profit per unit has to be, see the formula itself they given very clearly. Preparing cost divided by total cost into unit profit. Unit profit is 4. Preparing cost is 8. Total cost is 12. So it is 2.67. So total has to be 10.67, sir. Transfer pricing has to be 10.67. Profit per unit has to be 10.67 minus 4. 10.67 has to be profit, because 4 per unit is the variable cost. 10.67 has to be the transfer price. 6.67 is the margin. So 50,000 into 6.67. So which is 3,33,500. And last one is agreed market price of 8.5. So they have already given 8.5. So margin is 4.5. So transfer price is 8.5. Margin is 4.5. And total for 50,000 units it has to be 2,25,000. Clear? Okay. Now see illustration 2. So it is one of the past examination question, but to solve this illustration 2, you should require some knowledge which you learned in MA. So in cmainter, in MA, there is one topic called as ROI and RI, residual income. Let us see what is residual income. Residual income RI. Sir, there itself there is a meaning, residual. Leftover. But normally upon the capital invested, how much is the return we do expect? So we do expect capital employed into weighted average cost of capital. So because, sir, if weighted average cost of capital is recovering, it recovers to pay debt, it recovers to pay for preference shareholders, and it also gives required rate of return for equity shareholders. If you are able to cover back WACC, weighted average cost of capital, then it means we have recovered the returns what equity shareholders are expecting. So that's nothing but this is what our expected return. But sir, by introducing capital to the operating department, so what is the return what they are going to earn for us? Which is nothing but EBIT, operating profit. This is the profit what they are earning for us, and this is the profit what we do require. What additional profit I am getting is nothing but EBIT minus capital employed into WACC. That has to be the formula. So if you know this, then it will be easy for us to solve this question. RI is equal to EBIT minus capital employed into WACC. Clear? Okay. Now read this question. Okay, so let us see. Sir, XYZ Limited, which has a system of assessment of divisional performance on the basis of residual income, has two divisions, alpha and beta. Alpha has an annual capacity to manufacture 15 lakh number of special component that it sells to the outside customers, but has idle capacity. Now, the budgeted residual income of beta is 1 crore 20 lakhs. So, the budgeted RI is 1 crore 20 lakhs per beta, while the budget of alpha is 1 CR. So, alpha requires RI as 1 CR, beta requires RI of 1,20,000. Now, who is the transferor company? Alpha has annual capacity. So, this is irrelevant for us. Transferee company, this is irrelevant for us, and this has to be the relevant. Understood? This has to be the relevant for us, and this is irrelevant for us. Clear? Because transferor company wants 1 CR RI. We have to fix a transfer price in such a way that they should get a targeted RI of 1 CR. Okay. Now, other details are extracted from the budget of alpha for the current year as follows. For outsider sales, 12 lakhs at the rate of 180 per unit. Variable cost per unit is 1,60,000. Divisional fixed cost is 80 lakhs. Fixed cost is 80 lakhs. And capital employed is 7 crore 50 lakhs. And cost of capital is 12%. Okay. Sir, beta has just received a special order for which it requires components similar to the ones of alpha made. Fully aware that the idle capacity of alpha, beta is asked for to quote the manufacturing and supply of 3 lakh number of components with a slight modification during the final processing. So what they are saying is that alpha is having a capacity of 15 lakh units. Outsiders, they are selling it for 12 lakh units. So 3 lakh units, anyhow they are having vacant right. Fully aware of that, beta is asking for those 3 lakh units and asking for a quotation. Now, but they want some slight modification. Alpha and beta agree that this will involve an extra variable cost of 5 per unit. So for slight modification, they are going to incur 5 rupees extra. Now calculate the transfer price alpha should quote to beta to achieve its budgeted residual income. To achieve its budgeted RI, how much should be the alpha? Sorry, how much should be the transfer price? Clear? Now let us see here. So before fixing the selling price, what is the desired contribution? Or let us say, what is desired profit? That's nothing but EBIT. Desired profit is equal to RI plus capital employed into WACC. So this one, how much is, if RI is equal to EBIT minus capital employed into WACC, then EBIT has to be RI plus capital employed into WACC, right? It means that they have to cover 1 CR per RI, as well as based on capital employed of 7 crore 50 lakhs, they want a margin of 12%. 7 crore 50 lakhs, they want a margin of 12%. On and above that, they want 1 CR. So how much it has to be total desired profit? ₹1 crore 90 lakhs is the desired profit, sir. Then what has to be required contribution? Sir, from contribution they have to cover fixed cost, then only they are going to get a profit. Clear? Contribution is equal to fixed cost plus profit. So fixed cost they have to cover 80 lakhs. Along with that, they want a profit of 1 crore 90 lakhs. So what is the total contribution they do require? ₹2 crore 70 lakhs is the total required contribution by them. Clear? So 2 crore 70 lakhs is the total contribution which is required by them. Out of that, what is the contribution earned from external sales. Contribution earned from external sales is equal to how many external sales they are doing? 12 lakhs. From 12 lakhs, what is the external selling price? 180 and variable cost is 160. So it has to be 180 minus 160, which is equal to 2 crore 40 lakhs. Therefore, contribution to be covered from transfer sales is equal to 30 lakhs. 2 crore 70 lakhs minus 2 crore 40 lakhs. 30 lakhs they have to cover. Clear? Now, finally, transfer price is equal to, sir, first to manufacture that additional 3 lakh units they will incur variable cost plus required contribution per unit. That has to be the transfer price. Now, what is variable cost to make 160, but to transfer they have to incur 5 rupees extra. So variable cost is 160 plus 5. Now, what is contribution per unit? Total 30 lakhs they have to cover from 3 lakh units. So 10 rupees has to be the contribution per unit. So the total transfer price has to be 175. Sir, easy question only. So they says that they want minimum RI of 1 CR. RI of 1 CR. If they wanted to get 1 CR as RI, how much is the profit they should earn? That is RI plus capital employed into WACC. Because RI is equal to EBIT minus capital employed into WACC. Then what should be the EBIT? That's nothing but RI plus capital employed into WACC. Clear? Now, to get that profit, how much should be the contribution they earn? Because from contribution only, after deducting fixed cost, they are going to get a profit. If they have to get a profit of 1 crore 90 lakhs, how much is the contribution they are supposed to earn? They have to recover fixed cost of 80 lakhs. So, total 2 crore 70 lakhs they have to earn it. And how much they are earning from external sales as of now? 12 lakh sales they are doing, and from each unit they are getting 20 rupees margin. So 2 crore 40 lakhs they are getting from external sales. Clear? Then how much they have to get it from internal transfer then? From 2 crore 70 lakhs deduct 2 crore 40 lakhs. So total 30 lakhs they have to get it from internal transfer. Now based on that, let's fix the transfer price. So to manufacture extra 3 lakh units to division beta, first of all I have to manufacture unit. To manufacture, how much is the cost I am going to incur? No, fixed cost is not going to be incurred. Only variable cost is the additional cost which I am going to incur to manufacture for beta. Now what is my variable cost? Existing is 160, but as he is saying some modifications, 5 rupees extra. So 160 plus 5. And from total 3 lakh units, I have to cover 30 lakhs. It means 10 rupees per unit I am supposed to cover. As they are asking transfer price, it is per unit 1. So we calculated transfer price has to be . Read it once. Okay, see here. XY Co has profit center divisions X and Y, making products X and Y respectively. Each unit of Y requires 1 unit of X, and Y can sell a maximum of 50,000 units to the external marketing at a selling price of 150 per unit. So there are two divisions, X and Y. X has to transfer internally, and Y can sell maximum to the outsiders 50,000 units at a rate of 150. Okay. Each unit of Y requires 1 unit of X. Okay. So then X has to transfer internally 50,000 units. X has a capacity to produce 1 lakh units of. So X is having capacity to produce 1 lakh units. And the variable cost per unit is 12. Variable cost is equal to 12. And fixed cost is 7,20,000. So fixed cost is equal to 7,20,000. Now, X can sell the following quantities in the external market. So in the external market, it can sell at these demand. These are the prices. Okay, that's what they are saying. And assume no stock to build for X and Y. So there should not be any closing stock for both X and Y. Now Y can purchase its requirement from the external market at 22 per unit, but has to incur a bulk transportation cost of 1,50,000. Now Y can purchase goods from outsiders at a rate of 22 plus 1,50,000. Now for any quantity, it means for this is for any quantity they are saying transportation cost is 1,50,000. It means if you buy 10,000 units, if you buy 20,000 units, or if you buy 30,000 units, any number of units if you buy from outside, still you have to pay a fixed transportation cost of 1,50,000. Okay, which will not be incurred on transfers from X. But if they get transferred from X, they are not going to incur any transportation cost because both divisions are in the same premises. Required. Assume no demand from Y. If there is no demand from Y, what will be the best strategy for X? Let us say if there is no internal transfer, there is no demand from Y, then what should be the best strategy? It means that out of these units, what should be the number of units it has supposed to sell it? Simple, whichever is giving highest contribution per unit. So highest contribution total, that should be the optimal level of units we are supposed to sell it for outsiders. So if there is no demand, total capacity is 1 lakh units, but they can sell to the outsiders. If they have to sell more units, they have to sell it for lower price. If they reduce the price, they can sell, sorry, if they increase the selling price, they can sell only lower number of units. Clear? So if there is no internal transfer, then what should be the optimal selling price? What should be optimal selling price? So let us see how it is calculated. First bit, selling price, sale units, sales, variable cost contribution. So if selling price is 18, sale units will be 84,000. Or let us say instead of sales, let's go for contribution per unit and contribution. Contribution per unit and contribution, that will be better. What is contribution per unit? 18 minus variable cost per unit is 12, which is equal to 6. Then what is total contribution now? Sir, we don't want it to find out total profit because change in profit will be always equal to change in contribution. The more contribution, the more will be the profit. To decide optimal sales units, just to select a highest contribution level. That's fine. So 84,000 into 6, which is 5,04,000. Now, if the selling price is increasing to 20, you can sell 76,000 units. Then, what is your contribution per unit? 8 rupees is the contribution per unit. So, 76,000 into 8, you can get 6,08,000. Though units are reducing, because of getting more contribution per unit, your contribution is increasing. Now, when selling price is 22, you can sell 70,000 units. Now, contribution per unit will be 22 minus 12, which is equal to 10. So, you are going to get 7 lakhs as contribution. Then if selling price is 24, 26, 64,000 and 54,000. So 24 minus 12, 12 rupees. 26 minus 12, 14 rupees. Then 64,000 into 12, 7,68,000. 54,000 into 14, 7,56,000. So where we are getting high margin? At 24 you are getting more margin. At 24 we are getting more margin, so that should be the level which we are supposed to fix if there is no internal demand. So finally our answer has to be selling price of 24. That's what they are saying. Assume no demand. What will be the best strategy for X? So sell 64,000 units at 24 rupees. That should be the best strategy. Next, second bit. What will be the minimum transfer price that X will agree if X has to supply 50,000 to Y? What price will Y offers as the maximum? Sir, what will be the minimum transfer price that X has to agree if it has to transfer 50,000 units? Sir, if X is transferring 50,000 units, how many units they can sell for outsiders? Only 50,000. The units what they can sell for outsiders is only 50,000. So if they sell 50,000 units outside, what is the margin they can get? 14, sir, not 12. Because, sir, when they transfer internally 50,000 units, they sell 50,000 only. Whenever we are selling 54,000 or less, we can get a selling price of 26. Then why do we bother? Why do we sell at 24? Right. So 26. It's simply what should be the transfer price in the sense, minimum transfer price in the sense, variable cost plus contribution foregone, opportunity cost, cost versus buy, we already seen it, right? Variable cost plus contribution foregone. Now what has to be? So first let us set for minimum transfer price from X point of view. Now what is contribution foregone? Contribution foregone is equal to, now they are getting a contribution of 7,68,000. If they sell only 50,000 units, what is the contribution they are going to get? 14 per unit they are going to get it. Sir, see, contribution foregone in the sense difference between contribution now, contribution without transfer and contribution with transfer. Contribution without transfer is 7,68,000. Contribution with transfer, what they can get is 50,000 into 14, sir. This is the why. This is the point which I am supposed to explain. So I have given this question. So I have selected this question. Sir, it is 50,000 into 14, not 50,000 into 12. Because if you transfer internally 50,000 units, for external you are going to sell only 54,000, where you can get extra selling price. If we can get extra selling price, definitely we are going to take it. and we can get a margin of 14 rupees. Then what is contribution foregone? So it has to be 50,000 into 14, 7 lakhs and 7 lakh 60. So totally it is 68,000 is the contribution foregone. Therefore, minimum TP is equal to, what is variable cost per unit? 12 plus 68,000 divided by 50,000. That is equal to 13.36. So this has to be the minimum TP. Now what is maximum TP from Y point of view? So maximum TP from Y point of view in the sense, if they buy from outside, whatever the cost they are incurring, that has to be the maximum TP. Now, maximum TP is nothing but cost from external purchase. That is nothing but 22 plus 1,50,000 divided by 50,000, which is equal to 25 rupees. That should be the maximum TP. So if they wanted to transfer internally, X wants minimum of 13.36, Y can pay a maximum of 25. It can be, the transfer price can be any range between 13.36 and 25. So how much they are going to keep? It solely depends upon the negotiation capacity of both the parties. If division X can negotiate properly, then it will be nearer to 25. If Y manager can negotiate properly, then the price will be nearer to 13.36. Clear? Okay, next, third bit. If Y is acceptable partial supplies, let us say if Y is accepting partial supplies, what will be X best strategy under no compulsion to transfer? See, what will be X best strategy under no compulsion to transfer, but with the option to transfer as many units as it wants to? Sir, we are giving an option to division X to transfer how many number of units ever you can transfer. Then what do X will do? X will say that, sir, I don't want it to lose my existing customers. I don't want it to lose my existing customers, so that for external parties I'm going to sell 64,000. So if X is given an option, then number of units X will be willing to transfer should be equal to, their capacity is 1 lakh and for external party they are selling 64,000 units. Yeah, 64,000, only 36,000 units only they are willing to transfer. Number of units X will be willing to transfer will be 36,000 units only. Clear? Now, what will be the quantity that X will agree to transfer and corresponding price, assuming both divisions agree to share benefits of transfer equally? Sir, if they wanted to transfer in such a way that benefits of transfer pricing are shared equally. Benefits of transfer pricing are shared equally. Now listen. Sir, how do we get to know the benefits of transfer pricing? Sir, what is the total cost for Y if they buy from outside? Sir, if they're transferring partially 36,000 units, if they are transferring partially 36,000 units, remaining 14,000 units anyway they have to buy it from outside, and they cannot avoid this 50, they cannot avoid this 1,50,000. They cannot avoid definitely. So how much they can save? Only 22 rupees only they can save it. So total savings or savings per unit, savings per unit for internal transfer. Internal transfer is equal to, see, 22 rupees if we buy it from outside. If we buy it from outside, our cost is 22 rupees. I'm talking about these 36,000. 14,000 anyhow I have to buy it from outside. I have to incur that 1,50,000 bulk transportation cost. If I buy these 36,000 units from outside, the cost what I'm going to increase 22. Then what is cost of making? Sir, anyhow there is a vacant capacity. This 36,000 is anyhow vacant capacity only. Additional cost which I am going to incur to manufacture this will be only 12 rupee. Only variable cost is the only one which I am going to incur. No fixed cost I am going to incur. So my savings will be 10 per unit. My savings will be 10 per unit. Then what should be share of profit? Share of profit for division X, that has to be 10 by 2, which will be equal to 5. Therefore, transfer price is equal to, sir, they're going to incur 12 rupees to manufacture and they can recognize a profit of 5 rupees because the profits are shared between them equally, they said. So the maximum transfer price they can keep is 17 rupees. The transfer price what they can keep is 17 rupees based on third. What they say is that Y can accept partial supplies and we have given option for X to decide number of units to be transferred. As we have given option to X, definitely it is going to choose only 36,000 because they don't want it to lose their existing customers. Sir, today we asked for transfer so that if they have transferred 15,000 to be the transfer price, if they share profits equally. If they share profits equally. That is the thing. And we know that what is savings per unit if there is internal transfer. Sir, if there is no internal transfer, they might have sold it for 22 rupees to the external parties. But now, sir, for the same, if to make internally, they're going to incur only 12 rupees. 22 rupees they can save it from outside, but cost of making is 12 rupees, net saving will be 10 rupees. And out of the 10 rupees, both the parties will share equally. Then what should be the transfer price? Variable cost of making, which is 12 rupees plus profit recognition 5 rupees, total 17 rupees has to be the transfer price. Next, fourth bit. See here. What is the best strategy of the company? Will the company's overall strategy differs from the individual strategies? Compute the benefits and disadvantages. Sir, what if you consider as a whole company? As a whole company, then what is that? Transferring 50,000 is better or transferring 36,000 is better? So now what is savings? Savings by transferring 36,000. That has to be 36,000 into 10, which is 3,60,000. 3,60,000. But what is saving by transferring 50,000 units is equal to, savings by transferring 50,000 units is equal to 50,000 into 10 plus 1,50,000 also they are going to save it, but they are going to lose 68,000 rupees contribution from existing sales. That has to be the net savings. So from all the units, if they say if you are buying from outside, your cost is 22. If internally if you are making 12 is the cost, so 10 rupees you are saving. Along with the 10, as you no need to incur any bulk transportation cost, 1,50,000 also you are going to incur. But by transferring whole 50,000 units, they are foregoing 68,000 rupees contribution. So deduct that one. That will be the net saving, because anyhow this will be a cost to us. Even if there is no such savings, you might have got that 68,000 rupees extra, which we are losing because of transferring all the 50,000 units externally. Clear? Now, if that is so, what is the total savings? It is 6,50,000 minus 68,000, which is 5,82,000. Sir, as savings by transferring 50,000 units is more when we compared with 36,000 units, it is better to transfer 50,000 units as a whole company's perspective. Clear? So that's about the fourth bit. Just compare with when you transferring 36,000 units, what will be your savings? When you are transferring total 50,000 units, what will be your savings? And then you can give a conclusion point that when you think in the whole company's perspective, you should transfer 50,000 units internally. Clear? Okay. Yeah, that's enough for marathons. Thank you for attending. Please revise it properly and all the best for your exams.